Every single year we come here, it's exactly the same. I don't think the attitude has shifted on that front whatsoever.
Well, there is one individual here who I'm looking out for, because he is here, as he says, to read the riot act to the Davos elite, and that is the Heritage Foundation CEO. He said he was invited, he's avoided it for years, and he wants to come here and talk about where they've gone wrong.
Is he coming on with us?
Potentially.
We're trying to make that happen. Okay, let's make this happen. Check out the markets going into earnings season on Wall Street. We're going to round that up all up for you in the next 24 hours or so. Goldman Sachs and Morgan Stanley just around the corner. Later this hour, I believe, Lisa. Going into that, equity futures negative here by 0.4%.
We have another incredible lineup. A lot of people who are really going to give a view forward, including Cantor Fitzgerald Chairman and Chief Executive Officer Howard Lutnick. Fantastic timing given the bank earnings we've been getting, as well as Nuveen CEO Jose Minaya. Intel's Pat Gelsinger, does he rule the world? Can he make the chips for the Amazons of the world and the Apples? And Chevron's Mike Wirth, especially given this backdrop. We were talking Ken Rogoff. Why are oil prices not responding to this geopolitical turmoil? I mean, we talk all these highfalutin comments. How do people respond to them? You give you some sort of stimulus, an event, and try to predict the market outcome. Good luck to you.
I was speaking to a pension fund manager a little bit earlier on this morning, and we were talking about doing business in America, and we tried to bring up the topic of US politics and who was in the White House. He talked about states. He talked about the ease of doing business in some states versus others. I said, name them. Reluctant to do so. Yeah. Then he mentioned Texas. Mike Wirth talked to him about doing business in California a little bit later.
Especially given the fact that I believe they are not refining anymore there. They're pulling back from certain Californian activities. Yeah, because of regulation. And there's sort of this question of, can states take the helm given the sort of national uncertainty?
Mike Wirth of Chevron coming up a little bit later on today. We've got to start this hour with this conversation on Iowa. The front runner for the Republican Party is running away with it very, very early on. Libby Cantrell joins us now, Managing Director and Head of Public Policy at PIMCO. Libby, great to get your perspective on all of this and your insights. Let's just start with the results overnight. Hardly shocking. Where do we go from here?
Yeah, hardly shocking, and good morning from very snowy New York. Yeah, so I mean, in many ways, I think that the big question, John, was, is this going to be a coronation of Donald Trump? He's obviously been, as you've mentioned, the clear front runner in polls now for 4 months, and I think last night, honestly, sort of underscores the narrative that this is very much his nomination to lose. I mean, not only did he clear that 60%, which I think was something that was symbolically important for the Trump campaign, but in terms of the alternative to a Trump candidacy, there was no real clear alternative that emerged. Of course, Ron DeSantis came in second, a distant second, and then Nikki Haley a close third to that. But in terms of really, separating the field, separating that alternative and consolidating that sort of anti-Trump vote, if you will, that did not happen last night. So this was a very good night for former President Trump, and again, will likely just sort of corroborate that narrative that's in the market now, that this is very much Trump's nomination to lose.
Libby, you wrote one of the most interesting and quotable things in one of your notes recently, and Libby, I think about it all the time. You wrote, no, Jamie Dimon is not going to be president. No, Oprah Winfrey is not going to be president. And I asked you why, and you said because people are actually saying, well, maybe they'll swoop in and end up running. Can you speak a little bit about what you tell clients as they realize it is probably going to be another Donald Trump, Joe Biden matchup? What do you tell them about what a Donald Trump presidency would look like?
Yes, and I do, and we sort of say that flippantly, but we've gotten some, some questions, particularly from some of our, foreign clients who I think are a little bit befuddled by by sort of the American political situation, and potentially are saying that out of hope. Now, what we tell them is that just practically speaking, there will be no other kind of Democratic candidate. Joe Biden will be the Democratic nominee, and at this point, it does look like, now it's not for sure, and I would just say, as it relates to the Republican primary, New Hampshire is going to be critical. So if Donald Trump wins New Hampshire, I think this basically is over. But if he doesn't, and if Nikki Haley does win, then it's more of an open question. But really, it does look like it's going to be sort of a 2020 redux. And in terms of the policies, I think that if we saw a second Trump administration, it would be very similar to the first Trump administration. Lighter regulation, more tax cuts, those are things the market will like. But as you all have been mentioning, in terms of sort of the global landscape and the global posture, really much more of a retrenchment. And a much more protectionism, which as we know, as we saw in the first Trump administration, will keep the market on its toes. So this is unusual in that we basically have we would have basically two incumbents, a Joe Biden and a Donald Trump, running against each other. So in some ways, it's actually less uncertain because we know these gentlemen very well.
Yeah, and it's the gentleman, if you look at the polls, the Americans do not want to see going up head to head. But I want to ask you about the political timeline and really sit on New Hampshire. You have Nikki Haley sitting just behind the former president of New Hampshire. But now with DeSantis having a decent showing in Iowa, he's probably going to stick around. How does she chase the top and defend herself from the bottom?
Yeah, and I think that's exactly, that's why I think last night was such a good night for Donald Trump, because, again, there was no sort of clear second, no clear alternative to Trump. There was no sort of precipitating factor that really would lead to a consolidation of that vote. And as a result, as you say, DeSantis is likely going to stay in this potentially until South Carolina, and that is particularly bad for Nikki Haley. No, she has much more of a ground game and investment in New Hampshire. And so, and of course, as we know, this is a nuanced point, but it's important. It's an open primary in New Hampshire, so unaffiliated independent voters can vote in New Hampshire, not just Republicans. It's not a closed primary. So that will help her. So, I think we need to see something very definitive out of New Hampshire in terms of her momentum. And if we don't, again, I think this Republican nomination could be over before it really begins, and it would be Donald Trump again as the very likely nominee.
We also want to ask you about momentum in Washington, D.C. Are we going to be all going home to a government shutdown, or do you think Speaker Johnson can get this, I guess, prolonged, laddered approach done with a continuing resolution?
Yeah, it's the same menu, different waiter, if you will. It's the same dynamics, of course, that have electing, former Speaker McCarthy back in the fall. It's the same reason why we needed another kind of temporary funding bill late last year. And again, we've seen this movie before. It looks very much likely that we see another so-called continuing resolution until March 1st and then March 8th. Of course, Congress likes to complicate everything, so they've divided these two funding dates. But I think that bottom line here from kind of a market's perspective is that this is basically just noise, and it looks at this point like we will avoid a government shutdown yet again. But it looks very likely that we avoid a government shutdown. Now, come March, when I think the rubber will actually finally meet the road and they really need to pass these appropriations bills to fund the government through the end of fiscal year 24, that may be a different story. But at least for the foreseeable future, for this month, we probably have avoided a government shutdown yet again.
Hey, Libby, you're right. We've seen this movie quite a few times. Libby Cantrell there of PIMCO. The wonderful Libby Cantrell on the latest overnight in Iowa and the prospect of a government shutdown. I think as investors and market participants, Lisa, I think pretty much everyone has just been absolutely conditioned by seeing this story on repeat and seeing the same ending.
That they will eventually get a deal done. This is the reason why it's so hard. We talk about political dysfunction and we talk about just an inability to get things done. No one in markets cares. People are talking. Greg Jensen, Bridgewater, he told you, price to perfection, right?
Yeah.
We're dealing with something that markets are just looking past all of these things. And why shouldn't they? Because it hasn't come to fruition again and again in terms of a risk.
MH, that one's for you. Is it different this time?
Well, no, it's not different in the sense that the government's going to remain open. They are doing this laddered approach. I don't know why you don't just set one date for potentially the government shutdown. There's now 2 dates for potentially the government to shut down. As Libby said, they like to make things a little bit more confusing. My question is, does Speaker Johnson hold his gavel? Can he keep on to his job? Because McCarthy lost it with this same exact movie.
That's a big question. You know what TK would say? He'd look out into the distance, over into the mountains, and he would say, you can see Italy from here. And people would believe him.
You can't.
I would believe him. He would say it with such authority. He'd look out into the mountains, into the distance, and you can see Italy from here.
He speaks.
Coming up next, the governor of the South African Central Bank.
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
We don't think the rates will probably come back down to the levels we saw pre-COVID or pre this interest rate cycle, just because of the level of government debt and spending and the state of the economies across the world. So lower mortgages already, and we see that continuing going forward.
That was Charlie Nunn, the Lloyds Banking Group CEO, speaking to Francine Lacqua on his outlook for the UK economy and ultimately for rates. Big conversation about global rates here at Davos, Switzerland, at the World Economic Forum. We were talking to Ken Rogoff at Harvard a little bit earlier this morning. Lisa, high for longer was his mantra, really pushing that one quite hard.
Basically saying 3.5% was probably the ending rate for this Fed after they start cutting, because we do get this soft landing, right, if we go with sort of consensus narrative, and then going up to 4 and 5% thereafter because of the deficit. No one's talking about the deficit anymore. It only matters when people start getting worried about
Greg Jensen of Bridgewater did talk about the deficit.
And did he actually say he's going to trade around it?
At some point we'll get to that wall, that moment. I was like, how helpful is that? Like, what does that day look like? I always ask that. What does that day look like when we start to really care about it?
That's why you've got to focus on the auctions. It's all the auctions.
Okay.
The auctions come out, they fail, and then everyone worries about something happening.
You think it's
with
that
the
day you
deficit.
get like a proper failure?
Exactly, or just, yes, a day where there's a true lack of buyers, or at least, you know, just a feeling of frustration, a feeling of a lack of a bid. That's when you.
That's the day the frog dies. But for now, it keeps boiling.
Well, yeah,
something
the
like
frog
that.
gets revived after that.
Something like
That's
that.
what happened before.
Equity futures on the S&P look like this. Let's take a look. So a little bit later this hour, 7:30, you'll get numbers from Goldman Sachs and Morgan Stanley. Shonali Basak at our Global HQ is going to break that down for you in New York City. Already had a ton of earnings, Lisa, on Friday. Get more to come later this morning.
And what we're looking for is just some sort of forward look, because we kind of got a bleak look from some of the CEOs. Citigroup really coming out with a kitchen sink, saying they were going to be cutting pretty dramatically. What do you hear from Morgan Stanley and then perhaps more importantly Goldman Sachs, now that they're jettisoning some of their consumer-facing businesses at a time where the interest-bearing parts of the business really were the boon, frankly, for so many of the other banks?
We'll catch up with Ted Pick of Morgan Stanley a little bit later this week. We've got to catch up with one of my favourites right now, and he does not like the cold. It's Lesetja Kganyago, the governor of the South African Reserve Bank. Governor, good afternoon. How are you?
I'm good, thanks. How are you?
Are you enjoying this weather?
Well, it happens this time of the year after coming from 38 degrees Celsius. This is quite something.
We saw you in Jackson Hole. It was pretty cold that morning as well. That was late August, and we still didn't get the nice weather for you. I want to pick up on the conversation we started in Jackson Hole, Wyoming, together, the three of us. We talk about the Federal Reserve front-loading interest rate hikes, and every time you and I catch up, I think it's worth reminding everybody who follows this story, the original front-loaders were not the Federal Reserve and the ECB and the Bank of England. The original front-loaders of monetary policy and interest rate hikes came from emerging markets. Yeah. First question, are you going to be the first to cut as well?
You know, this is a discussion that fascinates me. Earlier on in your conversation, you were talking about a Harvard professor who was talking about interest rates being high for longer. And one of the things I always start my conversation with is, can we look and say how persistent has inflation is? Because that is the point of departure. And so far, inflation had actually been more persistent than we had initially thought. We have had a few readings where you had surprises. Just in my own country, in South Africa, we thought inflation was on a downward trajectory. It hit the low of 4.7, and before we knew it, it turned again before it went down. So inflation is more persistent. So if we want to know, want to look at which central banks are going to cut first, it's going to be those that have succeeded in bringing inflation down to target, or at the very least the ones with a lot more policy room. And you have seen that the early cutters this time around has also been the Latin American central banks that had very high real interest rates. They had that space, and that is what you should be looking at. In the case of South Africa, our real rates are not particularly high, and inflation has come down. It's within a target, but it is not quite where we would like to see it. And if we are to make any policy adjustments, we would have to see that inflation has declined to our anchor, which is 4.5%.
Has something changed, do you think? Has something changed domestically or in the international economy with regards to inflation since the pandemic?
Well, it's going to be an interesting call because I think that globally, central banks have underestimated the extent of the constraints that we face in the supply chains. Those have eased to an extent, but inflation is still stubbornly high, and that for it to be eventually conquered, we are going to have to keep rates higher for longer. I think that more importantly is that we are faced with something that, even in the case of South Africa, we hadn't seen. A public that is increasingly intolerant of high inflation. And that is what, for me, is a big change. And central banks, which in the earlier days were questioned about why are you so aggressive, why are you front-loading, they are now being criticized for not having done enough to rein in inflation.
We say a lot of times Jerome Powell is banker to the world, and I always feel bad for everybody else in the world who actually is doing policy for all of their specific countries. But is that the truth, that Jerome Powell, until he cuts rates, you won't get the all clear to cut rates because of the currency differential and because of the fear of devaluation?
A great central banker he is. He is the chairman of the Federal Reserve Bank of the United States, not the Federal Reserve of the world. And I have got no doubt that when he makes decisions, he and his colleagues make decisions, they make decisions based on the dynamics and the outlook of the United States economy. And that, for me, is very important. I think that in our case, yes, the U.S. is a big economy. We are a small open economy. We watch what the U.S. does, but we do not necessarily follow the U.S. in every move that they did. And case in point that Jonathan was raising was in 2021, when we saw that inflation was creeping up and there was a narrative amongst the advanced economies that it was a temporary phenomenon. We took a view that as emerging markets, been there before, seen it before, it's time that we act. And I'm glad that we acted at that time because we were able to start moving towards target much earlier than the advanced economy central banks.
The fact that you were an early sort of seer of what was going to come makes it really interesting to me that you're much more reluctant to signal cuts than over in the United States. And I'm wondering, do you agree with the Ken Rogoff view of the world, that essentially because of higher deficits and stickier inflation due to the supply chain disruptions that you were just talking about in response to John's question, that rates have to remain higher for a much longer period of time?
I would take it further. It's not just deficits. Look at the levels of public debt across the world. And these levels have got to be brought down. And one of the things that had happened historically was to almost inflate is actually available for the treasuries. Two, you have got treasuries globally that had been addicted to very cheap money. That era of cheap money is gone, and many treasuries are finding that they are borrowing at rates that are significantly higher than what they were borrowing at before the pandemic and during the pandemic. And third is that even in that space, what you are having is that you have got a whole generation of the public that had known only low inflation and low interest rates. And now inflation has risen and interest rates had to rise. And so you have got to rein in inflation because they are intolerant of inflation. And so you will see interest rates being higher for longer until the battle on the inflation front has been won.
We've got about a minute left with you, so let's do something provocative. You introduced the topic, though, not me. Sometimes governments make life harder for monetary policy officials. I believe there's a budget coming up, and I'm wondering domestically what you'll be looking for in that budget in South Africa.
Well, I like returning the favor. If the Minister of Finance was sitting here and you asked him what he expects of the central bank, he was going to say that he doesn't venture into that. So I don't venture into that. But they pronounced...
Christine Lagarde does politics. Why not?
They had, well, you see, some of these central bankers might have been politicians before. I haven't been.
True.
So,
Carry on.
Yes, but I think that there had been a pronouncement from the South African National Treasury to set the fiscal policy on a sustainable path. I have got no reason to second guess them. I have got every reason that if they had made a commitment, they will meet that commitment. But fiscal policy is not going to be easy this year. There are more than 60 countries going for elections.
I know. It's a massive year for elections.
So it's not going to be easy.
That was the diplomatic response I expected. Governor, you're a good friend. It's good to catch up.
Good to be here.
Good to see you. Governor Lesetja Kganyaga.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money, and number 2, don't forget rule number 1.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Gains from Goldman Sachs just out. Let's head over to New York City and catch up with Bloomberg Sonali Basak. Hey, Sonali.
Good morning, John. We have Goldman Sachs numbers out, and we have them beating on a number of key metrics here. We have them beating on revenue. We have them beating very handily on equities trading as well. They mixed on fixed income trading, but we know that the market was softer when it came to interest rates, currencies, commodities, credit. But, one thing we know about Goldman Sachs is they are pushing hard to win on financing. And there is where you see record numbers in their financing businesses when it comes to trading. When I tell you that they beat on equities, I'm telling you that they came in meaningfully above any other competitor here on Wall Street, both for the quarter and for the full year. When we see Morgan Stanley's number come out, it is very handily the case, potentially, that they have also beat Morgan Stanley on equity sales and trading figures as well. We have Morgan Stanley figures out as well, and I can tell you right now that Goldman has beat them once again for the quarter in equities trading. As we watch Morgan Stanley's numbers come across the wire as well, the numbers look strong. Also, John, you have Morgan Stanley's wealth management net revenue beating expectations as well. They, like Goldman Sachs, had one-time charges on other matters from Morgan Stanley. We know also that was a provision for legal expenses as well. But we are looking at strong numbers across the board. You are seeing the stocks reacting. Goldman now up about 0.6%. Morgan Stanley up by 1.6%. Remember, for Morgan Stanley, this was the final quarter of James Gorman's tenure, and now they are passing the reins over to Mr. Ted Pick.
Sonali, we are hearing from David Solomon, Goldman Sachs, in the release calling 2024 the year of execution. What exactly is the year of execution?
You have to remember last year throughout the year that there was a lot of quarters where they had returns that were either muted, below expectations, and sometimes the worst they've seen in years. And what you're seeing now is them really turning around the story, not only beating on some key metrics here, Lisa. I will say they're the only bank that brought in more than $1 billion in advisory fees in a bad year for deals. Last year, they're bringing in more than $1 billion still in advisory fees. So you have them beating on the things that they are known for, trading, investment banking, and they're having their asset and wealth manager also beating expectations here. Remember, last year, they took a lot of charges tied to assets in that consumer unit, either that they were offloading or when it came to their historical principal investments. Remember, these are these balance sheet heavy investments for Goldman Sachs that they are trying to reduce reliance on. And in the most recent quarter, you saw them announce that they have really beat a lot of their fundraising expectations here and bring in more third-party money than they set out to do, as well as beating in net revenues at that asset and wealth manager. So they're showing progress. They still have that table with the one-time items that they've had the last couple quarters, but when you look at the hits that they've been taking, say tied to those historical investments, the scope of those losses are much, much lower than we've seen in prior quarters. They are being really prided here for being conservative on the onset. And even when it comes to their loan portfolios, the losses are starting to become more muted over time. And so David Solomon, on day one really, or the beginning of the new year, is coming out and saying, this is Goldman's strategy. We have made some mistakes in consumer before, but we are moving on forward and focusing on the core business. And the core business is where you're seeing some wins.
Sonali, just zooming out as we parse through all the numbers, and we'll be analyzing this, and you'll be analyzing this in the hours to come and with all of the analyst calls, but we're seeing credit losses come in much lighter than previously expected. For Goldman Sachs, expected losses for credit, $577 million versus an estimate of $621. For Morgan Stanley, that number is even more shocking. It's $3 million versus $133 million. Do you get a sense that basically the banks are sounding an all clear on consumer and corporate creditworthiness at this point and saying the economy is better and people are going to pay their bills?
Lisa, you have to look at it in two terms here, because you did see the biggest banks, JP Morgan, Bank of America, on the charge-off rates come in a little higher and guide for the year that charge-off rates would start to increase through the year. For JP Morgan, that's less than 3.5%, and for Citigroup, that's between 3.5 and 4%. These are above pre-pandemic levels. But Goldman Sachs and Morgan Stanley, when you look at these provisions, they are weighted to the wealthier consumer, and they're weighted towards these institutions. And you have not seen the type of stress in those markets that were initially expected from many investors here. It's yet to see how the year shakes out, but should rates start to come down, then that distress and that those losses on credit books could be less pronounced than initially expected, as you know. And what's interesting is when you look at these numbers from these big investment banks, yes, we are seeing some weakness in underwriting fees still. In fact, Goldman had missed on both forms of underwriting here. However, you are seeing a jump back, which is a signal that perhaps people are ready to take on some more risk in credit markets, which bodes well for the likes of Goldman and Morgan Stanley that are ready to take on some risk after such muted provisions, to your point.
Let's get to the early moves in the pre-market off the back of some of these numbers. Goldman Sachs just a touch positive, up by 0.1%. Similar story for Morgan Stanley, positive here by about 0.6%. Shonali, that does it. We've had all the big earnings now from Morgan Stanley, from Goldman, from Citi, Bank of America, Wows, the likes of JP Morgan as well. Let's push forward and think about regulation. That's going to be a big feature of the conversation here at the World Economic Forum in Davos, Switzerland. We know they're unhappy about the prospect of higher capital requirements. Shonali, help us frame that situation right now. Where's that conversation heading?
It's headed in a direction that's getting quite ugly here because you have the banks pushing back very hard and saying to lawmakers and the Fed that not only will it constrain lending to have these capital requirements, but remember they have operational risk targets that they have to potentially be beholden to, as well as other types of constraints on their trading activities, which they argue would be a pain to the Treasury market, for example, John, which we already know has seen some pains in recent months. So certainly they're fighting back hard. None of these bankers, we heard it from James Gorman himself, who was a staunch person to advocate against those rules, that they don't think that they're going to pass in this form. Another thing to consider is what does this look like heading into the election cycle, and if we have a different administration moving forward, do these banks have the same sort of difficult regulatory environments here that they've had in the last 4 years? Remember, it's not just capital constraints. These banks have faced record fines as well through agreements they've made, settlements they've made with different regulators. So certainly regulation will be a big part of this story. The trading books in particular are what I'm watching because a lot of these firms have made really large windfalls from trading activities in recent years, and that could be something that is more constrained when you see the likes of Jane Street and Citadel Securities also starting to rake in record numbers as these banks face more regulation.
Hey, Shonali, thank you. Great work, as always, breaking down the numbers on Wall Street. Morgan Stanley positive by, let's call it 2% in the pre-market. Looking at shares of the likes of Goldman Sachs positive by almost 1 full percentage point. Lisa, we'll talk about the earnings in just a moment. Let's talk about the regulatory regime. We're not on a one-way track here. The pendulum could swing the other way around. Given what happened in Iowa overnight, super early days, I know. But if you get a change in the White House, could we get a change of regime?
That's what we heard from Libby Cantrell, that what we can expect from a Donald Trump presidency 2.0 would be something similar to what we saw before. Lighter regulation, less taxation, which would be something that the banks would benefit in. Although it doesn't seem like the bankers are really backing Donald Trump. I think that that's sort of interesting. They're not. They're really actually backing Nikki Haley and other potential candidates that they have been until this time.
I think everyone's hopeful that we can turn the volume down on U.S. politics. Isn't that the ultimate hope?
That's certainly the ultimate hope here, and I think that a lot of people are hoping for the same, which is the reason why everyone's surprised at the outcome that seemed an inevitability in the weeks leading up to this.
Without a doubt. Let's have a conversation about the earnings and not the politics. Jared Cassidy joins us now, a large cap bank analyst at RBC Capital Markets. Jared, great to touch base with you once again. Numbers from Morgan Stanley, from Goldman. Your first reaction?
Thank you, John. When you take a look at the numbers, they were very similar to what we saw on Friday with JP Morgan, Citi, and Bank of America's capital markets divisions. The investment banking numbers were the numbers that were better than expected in advisory, but generally ECM and DCM were numbers are on the light side relative to expectations. When you go into the trading side, similar to the others, we saw mixed results today. Equity trading was strong, FICC trading not so much as against expectations, and that was similar to what we saw on Friday. So overall, the quarters in capital markets were decent quarters. They weren't blowout great quarters, but they weren't real problems either. And the real key question, John, is what is the outlook for 2024?
And we heard that from the likes of JP Morgan, Citigroup, and Bank of America, and it wasn't that positive. Do you expect to hear the same kind of dash of cold water, at least attempt at it, from the CEOs of Morgan Stanley and Goldman Sachs?
Well, Lisa, it's really going to be market dependent. And it's interesting because, as you know, during volatile markets, trading does quite well. First quarter of 22 is a good example of that when, sadly, Russia invaded Ukraine. But it's not very good for investment banking results. Investment banking needs stability, steady markets. And now with the Fed looking like it's on pause for raising short-term interest rates, if we have some sort of pause or steadiness in the markets and rates don't go up higher from here, I think investment banking, particularly in the ECM and advisory business, could be the standouts in 2024. But then we may not see as strong trading numbers, particularly in equities.
Who's winning right now, Gerard, in the banking earnings race?
I would say that they're all clumped together, but you have to put, in terms of in the capital markets business, as you pointed out earlier in the program, Goldman Sachs is a dominant player in capital markets, as is JP Morgan. Those guys go neck and neck as number one and number two. And then you have, of course, Morgan Stanley, Bank of America, and Citi in the second, third, and fourth third, fourth, and fifth places. But I would say that there was no real standout where somebody was head and shoulders above the others. They all had decent numbers in the quarter.
Gerard, we're at the World Economic Forum in Davos, so we can push out the timeline a little bit and make some guesses about the future. So let's do that together. What do you think the banking industry is going to look like, Gerard, in the next 5 years? What are the kind of business lines that these companies will have to pull back from, ultimately because of the regulatory environment?
It's very interesting, John, because the Basel III comment period ends today. We should expect to see a number of comments coming from all the big banks pointing out why they should peel back the Basel III endgame regulations. I think the worst is priced in. But yes, there will be higher capital requirements, particularly within the capital markets business, in the operational risk area, for the trading books in particular. But this is going to be interesting, John, when you have that longer-term outlook. And I don't want to sound too Pollyannish here, but after this is finally said and done, which hopefully this year we'll get the final proposal, what is it going to look like for the next 5 years? Is this it? We think it might be. Imagine the banks having the opportunity to know that these are the final regulations for the next 5 years and they're not going to change. That's a very positive outcome. Granted, profitability will be lower because of higher capital, but just knowing what the goalpost is and not having it move is a positive.
Does it enable these CEOs to trot more heavily into private capital, which we've been talking about extensively, how much that's really taken a lot of the business out of the traditional bread and butter of banking, say, 20 years ago?
You're right, Lisa. It has made big inroads, particularly in the last 12 to 24 months. And certainly the banks will look to get more involved there. But we always have to be careful. Whenever we see rapid growth in credit extension, which is what's going on in the private capital area, you always got to be careful about that, because we know from history, whenever you see that in an economic real slowdown or recession, that comes back and gives you a hard time. So, yes, I think they'll get more involved in it. They'll do it more cautiously, but that is a line of business that the big banks will likely pursue over the next 12 to 24 months.
Hey, Gerard, great to catch up, sir. As always, Gerard Cassidy there of RBC Capital Markets. Numbers out from Goldman Sachs and Morgan Stanley in the last 10, 15 minutes or so. If you check out the moves in the pre-market, both stocks are in the green, both positive by something like 1 to 2% in the first 15 minutes. Not even Bramo responding to those numbers as they drop. The regulatory regime, to his point, let's think about what Gerard's just told us. If we do get a rush into private markets, is Moody's right to warn that you could get a race to the bottom, specifically in credit?
This has been something people have raised for a long time. Have we seen it yet? It's unclear, because there isn't a lot of transparency. We'll only know it when, who was it who said, was it really Warren Buffett, that when the tide rolls out, that's when you see who's swimming naked? I mean, there's sort of a sense of that, but the tide hasn't rolled out. So I guess we'll just have to see.
And we don't want to see anyone swimming naked either, let's face it.
You really had to go there.
No, I mean, you brought it up,
yeah.
So I had to comment.
Yeah, you know.
We don't.
It's a metaphor.
Come on. Coming up on the program, Robin Vince, the president and CEO of BNY Mellon. That conversation just around the corner, live from Davos, Switzerland, your equity market on the S&P 500. Equity futures shaping up as follows, pulling back through most of this morning. We're negative here by 0.3%.
younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
resilience of not just the economies but also financial markets, to the geopolitical crises that are going on, to the rise in interest rates and the fight against inflation, has been remarkably strong. Whether that continues, I think we're all hopeful, and the overall sentiment for 2024 is positive.
Thank you. The overall sentiment for 2023 was dreadful and 2023 was pretty decent, so 2024 is positive and we'll see how that turns out. That was James von Moltke there, the Deutsche Bank CFO. I know I sound super snarky, but you always get the feeling anything that's said at Davos kind of needs to be pushed back on because, as I said earlier, it's like a highlight reel of bad forecasts.
Well, it's been literally every forecast heading into every year. It's all been wrong. So if we're saying everything's going to get turned on its head, it's rather bleak because everyone seems pretty optimistic about 2024.
So less of the snark. Let's reflect on this. The last 12 months, I think it's absolutely phenomenal that we've seen the Federal Reserve go from 0 to 5.5%, from QE to QT, and unemployment is still below 4%, and GDP in the third quarter had something close to a 5 handle. So we should really be reflecting on the resilience of this economy and financial markets as well, for that matter. The fact that credit spreads are as tight as they are, you look every single morning, and equity markets are a whisker from all-time highs. That is certainly not where we thought we would be 12 months ago, and I would even say maybe even 6.
So I'm going to ask this to you. Have you heard any explanation for that really seems definitive? There's the resiliency. There's the fact that people got gobs of cash and hoarded it. There's the fact that companies got gobs of cash and hoarded it. But there's this big mystery. If rates stay at these elevated levels for a prolonged period of time, will we see the same resiliency or will things change? And I don't think that question has really been answered in any kind of meaningful way.
Well, I think that's the hope, that we just go back to the old world, that rates are coming down. There's a great phrase in credit, and I'm sure you know it, survive until 25. Just get to 2025 and rates coming back down, it's going to be okay.
As long as rates come back down, but we heard from Ken Rogoff, they're probably not. And I think that's really one of the questions overhanging this sort of hope and dream of a soft landing.
Let's start the conversation here on resilience with Robin Vince, the president and CEO of BNY Mellon. Robin, good afternoon.
Good afternoon. It's great to be with you both here in sunny Davos.
Fantastic to catch up with you. I did not realize how old your bank was. What's the number now?
240 years old this year. This is our anniversary year.
So let's talk about resilience of your institution and the resilience of the last 12 months. How impressed have you been by that, both from an economics perspective and a markets perspective as well?
Impressed is the short answer. I think at the beginning of the year, you were both talking about this in your intro. 2023 was not the year that most people were predicting or expecting, and I think we saw, and certainly we saw, the fact that our clients were looking for a partner like us to be able to help them to navigate the ups and downs. And we have platforms that span the financial world, and and being able to be resilient. We saw the importance of it. We saw it in the spring with asset and liability management. That actually does matter for a bank. And we saw it again through the course of the year with operational resilience. At the end of the day, you don't get to be 240 years old unless you are resilient, unless you're helping your clients to be resilient too.
It feels like a different moment for financial services. We saw some job cuts at BlackRock in the last week. Also saw an acquisition as well, to be fair. Saw some job cuts from you, I believe, in the last year. Was it 1,500?
We saw some job cuts earlier on last year. Look, we're always optimizing our workforce, but last year was also the year where we doubled our analyst intake of new graduates out of college, and we're going to double it again this year.
Are you happy with the size of the workforce at the moment?
Look, at the end of the day, our workforce is reflective of what it is that we're trying to do for our clients. There are tailwinds associated with more efficiency. AI is a good example of it. There are also counterforces, which is more business and more things that our clients are demanding of us. We launched new products last year, new products that have innovation at their core. We are focused on being able to extend buy-side trading. That's a platform we have. We've extended it to our clients. We launched a new platform in the form of Wove, which is for the wealth market. And so there are puts and takes in the headcount equation for sure.
I'm going to go to markets in 1 second, but since you're talking about employment, how much has the work-from-home model died?
Well, Lisa, our view on that is that we want to be flexible. We've got 3 pillars of strategy at BNY Mellon. We are wanting to be more for our clients. We're wanting to run our company better, but we also want to power our culture and takes with that. We need to give to them flexibility as an example. We also did a program called BK Shares last year, where we made every person at BNY Mellon a shareholder of the company. We've also improved our health benefits, mental health benefits, with premium-free healthcare. But we also ask more from our people, and we do ask them to be here at least 3 days a week, helping, driving our clients forward, contributing to pushing forward knowledge with I just talked about our analyst program. You can't have new analysts in the building unless you have people to teach them.
So when you talk about income, one huge component of income for a lot of banks this year has been the fact that interest rates have been high and they don't have to pay as much interest to a lot of deposit accounts, and that's been a real tailwind for profitability. How much does that go away this year?
So NII was an important part of our growth last year, not the only part for sure, but we said at the beginning of the year that we expected 20% of NII increase, and we actually delivered more than that by the end of the year. We didn't change our guidance. It was important. We've got a lot of very sophisticated clients. We're largely an institutional firm, so our clients at the end of the day expect good pay of interest from us, and that's what we've delivered to them. Now, our prediction is that NII will soften this year. Most other banks have said similar things, and so that's where the fee and the innovation from our new products and services, that's really what will drive us forward, and that's what we said to the market when we announced earnings last week.
Last spring was tough for the banking industry. Can we reflect on that just for a moment? Precisely. So these specific banks that went under and struggled, and it felt like for a moment that maybe the financial system was under threat, and then we moved on really quickly. Any lessons from last year?
I think, Jonathan, there were a lot of lessons that we put into practice last year. Now, some of us have been practicing them for a while. You talked about resilience as we were starting off. Asset and liability management is a pretty core fundamental concept for a bank, and you have to do it really well. That's table stakes. We were reminded of that, but I wouldn't call it exactly a lesson, although it did depend who you were. And then as we went through the year, we had other examples of the importance of resiliency. Cyber's always on our mind, but so is innovation. We talk about AI a lot here at Davos this week, and AI is going to be important. We believe, we're excited about it, but at the end of the day, it needs to have guardrails. If we don't do those things well, like many things, it's going to be a problem. We view resilience as a commercial attribute, and our clients do too.
How excited are you about crypto? And I say this because you were the first major bank to offer custody services for crypto-related assets in 2022. So are you expanding that out? Are you kind of going to all of the parties that are being held here at Davos for the crypto space?
You know, I'm skipping the crypto parties, but what we have been doing...
That's the right answer.
100%.
Sounds like you've been having a lot of fun at them, but...
Absolutely not.
But what what we've been focused on all along in the digital asset journey is the technology. Blockchain, we think, is going to be important for markets. Digital assets over time, tokenization, new assets being able to come into the mainstream financial system. Look, we touch 20% of all of the investable assets in the world. And so when there are ways to take assets that have not been easy to handle as part of the financial system and make them more mainstream in their operations, tokenization is an example of that, we're all for that.
Got a minute left, work with me. Faith in humanity. I wonder how much faith in humanity you have. Every single time we make some kind of technological advancement, we just end up working more. Now, AI, if it's going to transform our working lives, do you think we're just more productive but do even more? Or are we actually going to work less?
Well, AI is going to change the nature of jobs, at least in our view. We've been deploying AI into our workforce and into our products. I'll give you two quick examples,
sure, please do.
Which is right on point. So first of all, we play a very important role in the US Treasury market, and that vantage point allows us to see things, but AI helps us to see them more clearly and provide insights to our clients, and our clients are very interested in that. And an example of just improving quality of life, exactly to your question, we've had AI started to do draft writing of some of our research reports. And it's not to replace the person who's writing it. They used to have to get up at 4 a.m. in order to write the report. Now they can get up at 5 because they've got a first draft courtesy of AI. I'd say that's an improvement.
And now they work until 9 or 10 p.m. at night. I mean, I'm joking. I'm joking. That's my lack of faith in humanity. I'm just so fearful that we'll make these advancements, but we'll all just work more.
I love it. 1 minute. Faith in humanity. Go.
Let's go.
I hear you. I hear you. I mean, it's going to happen for the people who are in positions where they can do that, and then everybody else lose their jobs.
Human nature is human nature.
It's going to be
Robin,
great.
this was great. Really thoughtful stuff. Fantastic to catch up, sir. Thank you.
Great to be with both of you. Thanks.
Good to see you. Robin Vince there of BNY Mellon. Plenty still to come on this programme. Coming up, we'll catch up with Howard Lutnick, the chairman and CEO of Cantor Fitzgerald. Also need to talk about financial markets with equity futures on the S&P 500. Looking a little something like this following earnings from Goldman Sachs and Morgan Stanley around about 25 minutes ago. Equity futures still negative on the S&P. Lisa, down about a third.
And we're definitely watching the bond market as well, with yields just inflected a touch higher, maybe looking at possibility that the Fed's not going to cut rates as much.
Up 6 basis points. More still to come on the politics as well. The results from Iowa. Bloomberg's Anne-Marie on a set with us here in Davos, Switzerland.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to. You can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels. You know, when you kind of look at it, and probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Under the hood, there is some indication that the labor market's a lot more balanced.
The labor market at some point, in our view, is going to have not necessarily, an incredible drop-off, but a more normalized progression.
We have the labor market issue. We have higher labor costs coming through the pipeline.
The market is probably going to have more of a pullback than what we've seen so far.
The markets are in a sort of choppy mode, probably stay that way for a while, especially for the next few weeks.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Live from Davos, Switzerland, for our audience worldwide at the World Economic Forum. Good afternoon. Good afternoon. This is Bloomberg Surveillance alongside Lisa Bravitz. I'm Jonathan Ferro, together this week with Anne-Marie Hordern. We talked about Davos and the World Economic Forum being a highlight reel of people forecasting poorly. It's also a highlight reel of people complaining about the cold and sitting in the snow, which I've never made sense of. It makes no sense whatsoever. In a previous hour, we concluded that hour talking about resilience in the economy and in financial markets. The resilience that surprised us all. The fact that the Federal Reserve has gone from QE to QT, from record low interest rates to 5.5%, all in the space of something like 2 years, and yet here we are. Unemployment just south of 4%, GDP in the third quarter something close to 5%, equity markets a whisker from all-time highs, and credit spreads incredibly tight. Of course, that resilience can lead to confidence, misplaced confidence, and maybe even complacency. Lisa, a word that I think that you're leaning on pretty hard as we kick off 2024 and our coverage of this forum. Can we turn to stability in 2024?
At a time where you have the election situation, which I think a lot of people are talking about here, where you have the potential for shocks, a lot of different conflicts that have been heating up in a dramatic way. The stability point, I think, is what stands out to me. They're saying, look, we can deal with high interest rates if they're stable. We can deal with stronger regulations if they're steady. This is a big if, right? On a year where everyone's talking about the potential volatility in all these elections and populism and misinformation, a whole host of other concerns that people are throwing out.
We can deal with politics if it's predictable. Anne-Marie, is it predictable this year?
Well, potentially following Iowa, it looks like Donald Trump is this individual that's going to carry the Republican Party, even though this is the election that Americans don't want. They don't want a rematch of Biden and Trump, but I've said it many times and I'll say it again. These two are married politically, and that's like what it looks like we're going to get in November.
Results from Iowa. Could you extrapolate that out through the rest of the primaries this year?
Well, so the thing about Iowa is that we saw Ted Cruz win Iowa in 2016. Things can change in a caucus room. You don't just go stop by, put your name, decide who you want to vote and put it in a ballot box. You actually have a discussion with people. But the AP, CNN, CBS News within 30 minutes projected Trump won. This is before people even got in the caucus room to have this discussion. This infuriated the DeSantis camp. So put Iowa to the side. Why Trump wanted to win so big is because he wanted to make a statement to DeSantis and Haley. But New Hampshire is really what it's going to come down to.
Can we really take 100,000 people who voted in this thing because it was nothing? It was so cold outside that nobody wanted to go outside.
Tamari's point, they didn't even count them.
I mean, they didn't have to count them. That's my point. This was an inevitability. And I think that what really strikes me is the shock of the inevitability to some people, certainly internationally, and that's what we've heard here at Davos.
Well, to Libby Cantrell's point, this is going to be an election of two incumbents. Trump is an incumbent running in a primary with people who are chasing him, but he's an incumbent president and wants that spot back.
If you want to kill the conversation in Davos, Switzerland, ask someone on the record about the former president becoming the president again. No one wants to talk about it.
No.
Yet they all seem to be fearful of it. I understand why at a forum like this. If you are a globalist, if you believe in multilateralism, I understand why you might be fearful about the former president getting back control of the White House. The difficulty that we've reflected on over the last 2 hours, I think, is a really, really important topic that we need to push every single policymaker on. What is Europe going to do? Why is Europe still so highly dependent on what is happening in America and what's going to happen in the election this year?
Even when it's on their doorstep, you look at one thing Europe has outsourced, and that's defense to the United States. There is a war in Europe, and you still have countries unable to reach the 2% target. A lot of conversations that are happening here. I just saw Secretary of State Antony Blinken, Jamie Dimon. They sat down with President Zelensky. He is here in a bid to try to get that ammunition and that aid to Ukraine, because at the moment it's stalled, not just in Washington, it is also stalled in Brussels.
I believe that Brian Moynihan of Bank of America also meeting with Zelensky a little bit later this week. We'll be catching up with Brian Moynihan later on, together with Morgan Stanley's Ted Pick. Plenty of coverage of financial services through the week in Davos, Switzerland. Let's turn to the price action on the S&P 500. Big morning for earnings from Goldman Sachs, from Morgan Stanley. Ramo, equity futures right now on the S&P lower by, let's call it, 1/3 of 1%.
And people are trying to game out what they don't know, the unknown unknowns. But what we're looking at today is some of the CEOs and executives that really are shaping those decisions. Coming up, we have the CEO of Nuveen, Jose Minaya. We've got Adina Friedman, the CEO of NASDAQ. We also have Pat Gelsinger and Mike Wirth. But coming up right now, I've got to say, I'm so curious to hear what Howard Lutnick of Cantor Fitzgerald has to say about the road ahead in a potentially tumultuous year.
Let's get straight to it. Howard, good afternoon.
Good afternoon.
Hey, it's good to see you. You might have missed it. We were talking about resilience in the US economy and US financial markets. Typically, we always talk about risk and vulnerabilities. Can we start with resilience before we talk about risk? How impressed have you been by how resilient the economy and financial markets have been?
The economy's hanging tough. Inflation has not gone away. All young people, they think interest rates of 0 are like normal. If you're 62 like me, you know that that's a manufactured nonsense. So here's my view. Steady Eddie. Okay, this concept, imagine the market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all. That is just a nonsense. If they get it wrong, they're going to get it wrong by staying higher for longer. And I think that is likely to occur.
If they stay where they are right now at about 5%, a little bit north of that, do you see capital markets activity coming back just because of that stability and that known?
Yeah, you just said it. Stability, it's fine. 5% is like a normal rate. I mean, we have a $34 trillion deficit. $34 trillion. Should it be at 2%? No, of course not. 5% sounds reasonable. I think the world can deal with it. But inflation is still too high and it's coming down. It's coming down, but it's not done. Come on. You go to the supermarket, you do all the things we all do. You gotta be kidding me. Inflation is not in the rearview mirror, and therefore, we're going to stay higher for longer. But it's not really higher. It's kind of here, maybe a little lower, sort of just to show off. But let's face it, 175 basis points, that, I think, is actually funny.
Well, okay, and that's what we heard from Ken Rogoff as well, that this seems like a pipe dream. That said, given that kind of backdrop of a soft landing and no Fed rate cuts this year, or very few of them, how much, can you give some sort of quantity or some sort of qualification of how much IPOs, M&A, high-yield debt issuance can really pick up in an environment like that?
Well, look, so trading markets, for the banks, trading markets are back. I mean, zero interest rates were boring. So we own BGC Partners. It's the largest, most successful wholesale financial service company. And that business is on fire, right? Stock was up 80% last year, and it's still only trading 7.5 times earnings because our earnings are jumping so high, it's kind of sticking with it. So BGC doing well. So the banks are going to trade really well. They're going to have really good numbers all year long because now there's reasons to trade. I mean, let's face it, when interest rates were zero, you call the account, bring a pillow with you. It was just boring. But now at least you can sell A, buy B. So I think the banks are going to do really, really well. So you can see financial services are going to do really, really well. And we should talk a little bit about crypto, too, before we finish.
Oh, well, let's squeeze it in. What would you like to say?
So remember when gold ETFs started? They were very exciting in 04, and it kind of stayed steady. There was all this hype that everyone was going to buy gold, and oh, come on. So I think Bitcoin ran up. It's kind of stay steady. But when the halving comes, it's going to start to rally and grow. So Bitcoin, I think, will grow. And there's a company that I like called Tether. It's a stable coin. And you know, I manage many of their assets. And the Tether Holdings is the name of the group. And the group, I want to say it here with you, from what we've seen, and we did a lot of work, they have the money they say they had. In the last attestation, they said they had 86 billion of assets and 83 billion of liabilities. And I've seen a whole lot, and the firm has seen a whole lot, and they have the money. And so there's always been a lot of talk. Do they have it or not? So I'm with you guys saying we've seen it and they have it.
So spot Bitcoin ETF, do you think that's going to restore confidence to the whole sector given what we've seen take place in the last 12 months?
No, that doesn't have anything. That's just a way for Americans to buy. Can I ask you a question?
Sure, please.
Why are Americans having anything to do with Bitcoin anyway? Why do they have anything to do with stablecoin anyway? Well, I can give you money on Venmo, on PayPal. It's not an American thing. This is Americans just cocking around like buying Tesla stock, okay?
Well, they're doing that plenty.
I know they do, but this is a speculative asset for us. But for countries like Argentina, Venezuela, Turkey, these crypto assets matter. Stable coins matter in those countries. Okay, they really do. It's a way to hold on to the dollar. So I think Tether's stable coin in Argentina, in Venezuela, in Turkey. I mean, imagine you're in Turkey. You don't want to hold a Turkish lira. I mean, come on. It's going to go down 50% this year. You want to hold the dollar, and holding it in a token, right? Holding your dollar in a token is amazing. So I think that's why Tether's doing really well. You realize Tether has $95 billion in issuance. It's a huge amount.
Moving slightly away from crypto, I know that you've called CME Group the extraordinary monopoly in America and have tried to figure out ways to compete more directly. So how do you plan to take them on this year?
All right, so 2024, it's coming. It's called FMX. So remember, we are extraordinary in the markets for U.S. Treasuries. So we have an electronic marketplace for U.S. Treasuries. It's been growing market share 2% sequentially each quarter. So each quarter, last quarter was 25, so we'll probably do 27 this quarter. Just sequentially, quarter by quarter, we're going to partner with all the major banks. All the important banks are going to be partners with us because they want to create a competitor to that awesome CME, just to keep someone a little honest, a little competition. So FMX is coming. We expect to get CFTC full approvals. We're going to announce all our partners who are banks, which will really be more of who's not in than who is in. It'll be less exciting because everybody's going to be in. And we will roll out a competitor to the CME in 2024.
We'll have you back on with another pitch. I do want to get to this idea of fixed income trading. You were saying that this is good before you could have a pillow. Now it's actually exciting and fun, but it's been maybe a little too exciting. We saw FIC results come in from some of the banks a little lighter than people had previously expected. What's optimal in terms of yield swings, and what's good or what's bad for traders?
Well, traders like volatility. They like movement. It doesn't mean it's always going to go their way, but they're in the game of making transactions with their clients. And if interest rates were zero this year, and interest rates were zero next year, and interest rates are zero, whatever, I mean, who's calling who? It's kind of boring. So this market is excellent. Whether it goes up, it's not going to go up anymore, right? We know interest rates are not going up, and that would be horrific if they went up. The market would just vomit everywhere if that happened. So the question is, how much are they coming down? I think the answer is a little bit, way less than people think. And I think you're going to see the banks do extremely well through this. 2024 is going to be really wonderful. You saw JP Morgan's results were great. Okay, Citi didn't have it as good, but you know, Citi's always on the back end of things. But I think even they'll get it together. And I think you're going to see the banks do really, really well. And they're going to be a wonderful performing asset in 2024.
You could replace caffeine. I think we've got to do more morning breakfast meetings with Howard Lutnick.
Totally.
Great energy, Howard. It's good to see you.
Great to see you.
Thank you, buddy. Howard Lutnick there of Cantor Fitzgerald. Where do you want to start with that one, Bramo? Let's just start with rate cuts. The rate cuts that are priced in are laughable. It's a joke.
That's what everyone's saying. And yet the market's pricing it in. The market's saying we're not buying it and we're still doing this. So who's right? And this really is one of the key questions. And the question also is, can there be a soft landing and this type of rate cutting forecast? Because right now, that is the dissonance. There's a lot of optimism for people who are saying it's a pipe dream that we're going to get these potential rate cuts.
Ken Rogoff, Harvard, called it just that, a pipe dream on this program. Coming up later this hour, the conversations will continue from Davos, Switzerland and the World Economic Forum. We'll catch up with Adina Friedman, the NASDAQ CEO, at 8:30 Eastern Time. Financial markets going into the opening bell about an hour and 16 minutes away, shaping up as follows on the S&P 500. Equity futures pulling back by, let's call it, a third of 1%. Yields are higher, up by 6 basis points and back to 4% on a 10-year. From Davos, Switzerland, this is Bloomberg.
To keep rate World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's not going to be as good as 2023, which was surprisingly good, but it's not going to be bad. Inflation's going to come down, soft landing, the 6 rate cuts. That's a pipe dream if we have a soft landing. That's not happening. We'll get 2 or 3.
That was Ken Rogoff, the Harvard professor and former IMF chief economist, earlier in the program, saying it was a pipe dream to have a soft landing in the 6 rate cuts that are priced by this market. Bramo, he's not alone. We heard from Howard Lutnick just a moment ago, who said it was laughable what was priced into financial markets.
He just said, it's not going to happen, so cut it out. And again, people are not listening. They're saying, look, what we see is commensurate with this type of rate cutting cycle. Who knows? I mean, we're talking about the soft landing and the political side of it, and how this is what the president wants.
Sure.
Well, can you have that Goldilocks scenario if you have rates staying where they are? And that's really the tension right now at this moment.
There's a ton of tension, that's for sure. Let's talk about the tension in financial markets on the S&P 500. Equity futures shaping up as follows. Earnings in the rearview mirror from Goldman Sachs and Morgan Stanley. Futures negative here by 0.4%. Yields up about 6 basis points. Let's call it 4% on a 10-year. The coverage of financial services continues. I'm pleased to say that joining us on set here in Davos, Switzerland, is Jose Minaya, the CEO of Nuveen. Jose, good morning.
Good morning. Thank you for having me.
Let's talk about the future of investing. And I want to start with this point. Whenever I talk about Nuveen, I don't think enough people realize that you are the #1 investor in farmland worldwide.
Yeah, I'd say natural resources in general, but farmland, we are by far the largest investor in it, and it's a conviction we took. We built that platform well over 10 years ago. Today, we're almost approximately 20 billion in AUM in that space, and it was one built for today's times, actually. It was one that we said, hey, inflation may show up someday. You may want less volatility in your portfolio. You may want more yield. And here we are today. We always say the hockey pucks come to us.
It's arrived, so let's talk about it a little bit more. The 60-40, things have changed a lot. Can you help me understand what the future of investing looks like? And perhaps we can reflect on something I talked about on a panel a little bit earlier this morning. You were in the room. Hugh Van Steenis, formerly of Morgan Stanley, wrote a fantastic piece in the Financial Times in the last few months. Originally, many years ago, he forecast that ultimately investing and investor flows would polarize into this ultimate barbell. And on the one side, it would be super passive, exchange-traded funds, cheap, convenient access to benchmark returns. On the other side, you'd have flows into specialized managers, alts, private markets, et cetera, et cetera. Have we arrived? Is that process complete, or is it changing?
I think it's always changing, but I think that's been going on for a while. And it made sense at the time. We've been going back to even 3-4 years ago, we were saying something that people understood academically. Again, you're going to have more volatility going forward. Returns are likely going to be lower in the next decade. And who knows, inflation may show up, and are you protected against it? And yield's going to be important. That, while people understood the academics of it, wasn't really an urgency. In a world where markets are doing this, you can kind of go out and say, I'm going to invest passively. And then, on the side, I'm going to look for these opportunistic exposures and just exposure on the alternative side. Today, that is more of an urgency. So you're seeing more and more creativity around solutions, products, innovation to try to get Main Street investors more access to alternatives to truly be more diversified.
What's the catch with financial creativity? Because when you say financial creativity, some people are saying, okay, so when are we going to actually see whether there are underwriting standards that are going down or there's some sort of pitfalls within these private markets that are less transparent and being replicated everywhere for higher fees?
Sure. Look, the catch is liquidity, right? That's what always is, again, people getting their capital locked up versus I can get it very cheaply in a very liquid way in an ETF, which is still a very viable vehicle. Yet, what is the value or the premium put on liquidity versus 10 years ago versus today? That additional return and alpha you get for taking illiquidity is very, very valuable today. So that's been the catch, but the perception of the risk behind liquidity or illiquidity, I think, has changed as well.
But how concerned are you? We think about sticky money, and we did see that real estate crisis, I should say, in the UK, within the past 2 years or so with respect to outflows and what happened with forced selling. We haven't really seen that forced selling yet for some of these funds that do cater to individuals. Are you worried about that at any point, that we are going to see that sort of pressure, that realization of losses that we haven't seen in certain private markets?
I really don't, because today what you've seen is the sophistication of investing in private markets and who's invested in private markets today, where it's very well balanced. Real estate, people love talking about real estate, and it's really around the issue that you're seeing in office. If you look at REITs today, 3% of their exposure is to office. The average institutional investor has maybe 10 to 15% exposure to office. They'll feel some pain there, but you know what? Things like life sciences, storage, logistics, they're doing fine. So again, it's an area of the sector where people are a lot more diversified than you would think, and the liquidity is going to be felt, or the lack of liquidity is going to be felt differently.
The ultimate question, I think, that leads to questions like these is, have we really paid the price for taking interest rates to 5.5% from zero? Do you think we have?
I don't know the answer to that. I will tell you that more and more, we've been on the camp of a soft landing, going into 2024. More and more, I think that seems more likely the case. When I went to school, the idea of the Fed taking up rates this much and being where we are would have been unheard of. But we are in different times, that's for sure. I am a believer that we are going into a soft landing. I think that there's a lot of cash on the sidelines today that even at these rates is going to come back into the system as well. But the uncertainty will be present there for the rest of my career, right? The idea that whether it's a geopolitical issue, whether it's a policy mistake, the risk of this thing going the wrong way is there and will continue to be there into the foreseeable future.
So you caught the end of the panel that I did this morning on peak private markets, and I think at the very end I tried to introduce politics. You saw the reaction to the participants when I tried to talk about President Donald Trump returning as President Donald Trump. How are you thinking about elections in 2024? How meaningful are they to you?
Yeah, I take lessons from the previous elections, and I will tell you, I've been through many different cycles of Brexit discussions, the Trump election, the first time around. We all looked around and thought about putting in hedges what we would do differently. At the end of the day, we took a step back. I can't control elections. I can't control the markets per se. We can control the fundamentals and how we pick good management teams, good companies. So I've learned to kind of move away from that noise and really focus on the fundamentals of what we do well and anticipate volatility.
When you talk about politics, I have to also bring up China. Xi Jinping has sent the biggest coalition from China to Davos since 2017. A lot of investors are still saying it is an uninvestable nation. Where do you stand on that?
Well, they've been a big part of the global economy for some time, and yes, they are not open to global investments from the international community, as, for example, investing in Switzerland or Germany, for that matter. But I will tell you, they are still an important part of the globalized economy. People talk about globalization also around, we're going the opposite way. No, we're not. The pendulum's swaying a little too far. People are understanding the issues of value chains. It takes decades to change them. So I still think China's going to be a big part of the equation, albeit people have learned some lessons and are going to be a little careful in terms of how they interact or make investments around that. We started a policy some years back, let's go long with China short, and let's do it in places like Australia. You could do that for some time. I'm not too sure. I think the world will continue to globalize.
Jose, this was great. Jose Minaya there of Nuveen. Jose, thank you.
Thank you.
Thank you very much. Plenty to think about here, Lisa. Particularly, I'll get my words out as I freeze to death, particularly on the elections in 2024 and the future of politics. I find it pretty amazing that we sit here and you listen to the Western investor who very casually talks about China being uninvestable, and we just move on straight afterwards, and we don't dig any deeper. It is stunning that we are looking at the world's second largest economy, and there are a group of very large investors, particularly in the West, in the United States, who have decided that China's capital markets is uninvestable. I think that's absolutely stunning.
It is stunning, except that when people have been burned for long enough, they don't want to get burned again. And the question is size. If you are a very large organization, you can't simply avoid the world's second biggest economy. And I think that that's really the struggle. It's not uninvestable. It's how do you invest at a time where there isn't policy certainty by any means. We talk about the uncertainty and the lack of stability in some of the political
Yeah, you're not going to get the policy certainty you want at this point. Also pretty hilarious the last hour or so, just to hear people's reactions to what's priced into rate markets. The pushback has been pretty aggressive, hasn't it, so far this morning?
The pushback being you can't get your cake and eat it too. That basically you either have a soft landing and not very many rate cuts, or you have a hard landing and you have a whole host of rate cuts that are substantially more than what we're seeing right now priced into the market. You got to get one or the other, and that I don't think is something people are really grappling with.
That spread between what this market is looking for and what's implied by that median dot in the dot plot from the Federal Reserve has got to be reconciled somehow, one way or another, through this year. Coming up on the program, we'll catch up with Adina Friedman of NASDAQ from Davos, Switzerland this morning. Good morning. Your equity market on the S&P 500, slightly softer.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
There's a little bit of economic data just around the corner. We'll get to that with Mike McKee in just a moment. Live from Davos, Switzerland, at the World Economic Forum, alongside Anne-Marie Hordern and Lisa Brabitz. I'm Jonathan Ferro. Let's get to the equity markets. Equity futures on the S&P 500 shaping up as follows. Equities look a little something like this. We're down by 0.4% on the S&P. On the Nasdaq 100, down by 0.5. The small caps, the Russell, just a little softer, down by 0.8. With that economic data, let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, it's tertiary data, but it's what we've got today, so it may get some attention on Wall Street because there's a big, big drop in the Empire Manufacturing Survey covering mostly New York area. The headline goes to negative 43.7 from negative 14.5. New orders fall to negative 49.4 from negative 11.3. Those are the worst numbers since May of 2020, which of course was in the teeth of the pandemic. The worst numbers that anybody had gotten were in that month. Prices paid go up, however, 23.2 from 16.7. Employment drops negative 6.9 from negative 8.4. So basically, you look at the headline numbers, guys, and it says cut rates sooner. Look at the prices paid number, and it says not so fast, but they are big numbers in any case.
Mike McKee, let's talk about it a little bit more. How unusual is it to see swings like that in that data point?
Well, we have seen some big swings in the headline numbers, but nothing of this magnitude. The question is it just because of the weather, because of winter? What is going on here? Is this an outlier or not? We'll see when we get some of the additional numbers like Philly Fed coming up later this week.
Mike, just quickly here, are we seeing any patterns in terms of deterioration or negative surprises in some of the economic data that's been coming out that's more real time, since this is really the first read on January?
No, we really haven't yet. The numbers that we'll get tomorrow should be very interesting because we'll get the retail sales figures and we'll get industrial production. And those will give us an idea of how both sides of the economy are going at this point. And we'll see if there's any kind of real drop off or not.
Mike McKee, Michael, thank you on the latest data, which was pretty dreadful, to be honest. Lisa, wasn't it?
I mean, it was really shockingly dreadful, negative 43 as opposed to the expected negative 5. You're seeing a bit of a reaction in markets. But again, I mean, you just wonder, okay, did it just get cold and did people not go out? Or was there something specific and
Wasn't that what we said about certain data points in December as well?
Or there was a strike or
Sure.
this particular thing. I mean, it's just, you can't really get too jazzed with one number, but people...
What was the North Star of last year? Jobless claims? Is that still the North Star? Is that the reliable indicator?
Was it that? Was it JOLTS? Was it some of these others? I mean, it sort of shifted depending on the month.
JOLTS in and around 200K, more JOLTS data, or rather jobless claims data, coming this Thursday. Let's turn to the price action, work through equities, bonds, and foreign exchange. We'll get to stocks first. On the S&P 500, equity futures negative by 0.35%. On the Nasdaq, down by 0.4. If we can turn to the bond market, yields actually higher all through this morning. Higher again today by 6 basis points, 3.99.92. Bramo, we've kind of been here all month, haven't we? Just in and around 4% on a 10-year.
The tension between the buyers and the sellers in the bond market, with this idea that either you get a soft landing and you get higher rates, or you get a hard landing and you get lower rates, and people aren't willing to resolve that. And I think that's the tension that's keeping things stable for now.
You know you want to do the euro, so let's finish there. The euro against the dollar. Where is it, Bramo?
It's probably, what, 108,
109.50, isn't it?
Well,
usually.
Where was it? Yeah. But now
sort
it's
of
like
109-ish.
Yeah, 109-ish. It's been
exciting
It doesn't
stuff.
really reflect any kind of massive divergence.
You're going to hear from Christine Lagarde, the ECB president, a lot this week. I just wonder if the tone has shifted since the December meeting, because what you heard from Christine Lagarde in that meeting was very different to the tone you got from Chairman Powell just 24 hours before her.
Although a lot of the ECB hawks have been out in full force, saying that there's going to be no rate hikes, or excuse me, no rate cuts, and that people are way over their skis. So if she takes a similar tone, that'll be interesting.
A similar tone we've heard this morning on the Federal Reserve. Let's continue the conversation here in Davos, Switzerland. With us, I'm pleased to say, Adina Friedman, the chair and CEO of NASDAQ. Adina, good afternoon.
It's great to be here.
It's good to see you. Let's talk about the transformation of your business. A lot of work is being done. I think a lot of our audience typically think of you as listings and exchange. Let's talk about what you're about to become. How are things changing?
Yeah, well, first of all, thank you. And obviously our markets are our foundation, and they always will be, and they're an incredibly important part of our business. But what we've been able to do is really expand our relationships with our clients across liquidity. Like, how do we bring technology to markets all over the world to make it so that the liquidity in the markets is greater? How do we help our clients manage risk so that they can bring more liquidity to markets? Transparency in terms of helping corporates and investors find and manage their investment strategies. And then the third, of course, is integrity, and that's where we have our anti-financial crime suite and our regulatory reporting suite, so that we really help the banks and brokers manage the integrity within the financial system. So we've gone all in across those three key pillars, and including our acquisition of Adenza last year, but we've been on this journey now for about 7 years.
Yeah, since 2017, you took over, and I believe you've had about a dozen acquisitions since then as you tried to broaden out. In the next 5 years, what proportion of your business do you think is going to be on the listing side, and what proportion do you think is going to come from some of the other fintech aspects that you've acquired and built out?
Well, we actually look at it in terms of kind of the trading business, and that's really between 70 and 75%. I mean, sorry, between 20 and 25% of our business today. And then we have our solutions businesses, which is all the data and the analytics, the software solutions, and that's actually between 70 and 75% of our business today. And with Adenza, that it gets even a little bit higher. So we're really, really pleased that we have a really complete suite of solutions that we offer corporates, investors, banks, and other exchanges that help them navigate all the complexity that the capital markets and the financial system introduce.
You know, I've got to say, at Davos, I've been really struck by how much discussion there's around artificial intelligence and how people really are trying to figure out what to make of it. And Kristalina Georgieva of the IMF said that one of her big concerns is financial stability, that she is very concerned that people are not moving quickly enough to adapt the financial system to just how quickly some of these systematic learning programs can actually work. What are you doing about that? Is that sort of entering into any of your calculus?
Yeah, I mean, first of all, I think that the financial industry in many respects is on the forefront of a lot of technological innovation. On the other hand, it has a lot of regulation that underpins it. So it has to move with the speed of regulation in some cases. So what we try to do is bring as much innovation as we can to the solutions that help them manage the regulatory environment. How do we bring AI into the tools that help them manage down crime? How do we bring AI into markets, actually, to make it so they have a better experience in the markets? We have actually our first AI-driven order type that's coming out into our markets this quarter. And how do we help them as a more advanced technology provider so that they can adapt more quickly to all of the risks that are happening around them?
Can we build on AI just a little bit more and help me understand how we're going to confront what could be a new era of misinformation? How will we manage that when it looks like we're very, very close to producing a very lifelike video of you releasing your earnings a day ahead of time and people believing it? How close are we to that moment, and how concerned should we be about that?
I think AI brings opportunity and risk, and that is a major risk. And so I think thinking about the regulatory environment on the use of AI in trading decisions, in investing decisions, is an area that the regulators are really focused on, protecting against what we call those deep fakes that could provide misinformation to investors. We have some blunt instruments today that protect the markets, like our circuit breakers. We have single stock circuit breakers, market circuit breakers. But what you really want to do is prevent that type of deep fake from filtering into investment decisions. And I think that we don't have honestly, we're still working on what is the answer to that. There's a regulatory framework, but it's really more of a technical question of how do you validate the videos. Like, you could actually use blockchain technology to do that, by the way. So how do you create almost like a validation mechanism? And I do actually think media has a big role to play in that.
We will, and I'm sure we have to confront some of that too. There was a very basic hack that we saw with the SEC account on Twitter only a week or so ago.
Which is ironic, considering that they're supposed to regulate it, and yet they were the ones that came out and said that they'd approved the Bitcoin ETF before it had happened.
Have you seen more of that, Adina, recently? Have you seen that threat materialize?
I would say that was, the answer is not more than what you've seen. So whatever's happened has actually gone out into the media. That would probably be one of the few examples that we've seen. So not yet. I think that the effort, though, is you have to think about security every minute of every day. And it's not just the CISO's responsibility to manage security in your business. It's every person's responsibility to manage security in their business. So we do a ton of education. That was a wake-up call to remind yourself on dual-factor authentication for your Twitter accounts or X accounts or whatever social media accounts you have. There's a lot of self-help, but there's also, it's a collective action that's needed across companies to make sure you're maintaining security. That's obviously a huge area of focus for us.
It's fascinating that you're talking about the investing in technology on one side, and then people think of the NASDAQ index as so tech-heavy and so dependent on a few of the major technological companies that have driven a lot of this innovation. Does it make the market more or less fragile to have a greater dominance of just a couple of key companies?
Well, I think that in general, the economy is moving towards having some really, really leading technological institutions that are really driving economic growth and prosperity, right? So we have to recognize that the indices tend to focus on and are really a reflection of where is the economy going and how is market cap evolving towards these larger technology companies. We also have to recognize that we're in a global competitive situation. It's not, you have to look at this in the context of maintaining the U.S. as a global technological powerhouse and enabling the businesses to grow and expand, to innovate, making sure the innovation ecosystem remains super robust so you have new companies that are always coming in to challenge them, and then also allowing for every company to have good liquidity with strong investor protection. And that's kind of what we focus on, but I think that it's really what you see in the index is a reflection of the economy.
When you talk about good liquidity, we have seen a real drop-off in IPOs. It was a really weak year for that, and people have been talking about interest rates needed to come down before they can. Are you seeing that actually as being a reality, that this year is going to be more robust, or are companies realizing that it's better for them to finance themselves in private markets and just sort of do it that way in perpetuity?
I actually think that we have about 85 companies that have filed to go public on NASDAQ. So it means they're ready. They're in the SEC process, and they're just ready for the markets to be open. At the end of the day, it's really all about the investor. Are the investors ready to put risk capital to work? And also, investors predict the future. So if they believe that they're confident that we're not going to have higher rates, and we could and likely will have lower rates over time, then they can underwrite that, right? So they can actually put that into their model. A big unknown has become more known, and then inflation has come down, so the cost of doing business has come down, and that all, I think, gives them more confidence in being able to underwrite risk capital, which means more IPOs. So that's a long way of saying I do believe that there's the opportunity for more IPOs this year.
Do you think we're still struggling to reconcile some of the private market valuations of the last few years?
I think private markets and public markets are always going to have a little bit of a different orientation. I'm going to say it that way. So private investors take big risk, right? They take small bites early on in a company's life, but a lot of them. And the VC community has to kind of bet on the future, and they tend to make 10-year bets. So they're going to have a different view of value than a public investor, right? And so I do have to say, I think the private markets and public markets will never be perfectly synchronized. I think that, private investors are going to bet on a longer-term future, so they might be able to wait longer, be more patient to grow into the valuation they're paying. And public investors want to have more liquid options, and they look a little bit more on what's that valuation going to look like in 2 to 3 to 4 years, not 5 to 10 to 12 years.
You've made a bet of your own. Let's finish there. You mentioned Adenza, $10.5 billion bet, sophisticated, educated bet. Are we happy with where we're at now?
Yeah, we're really excited. So we closed the deal in November. We're integrating. The team is incredibly energized. The solutions are amazing. And when we are having conversations with the banks, we now can solve their most complex challenges, right? So across regulatory reporting, risk management, and anti-fin crime, those are the biggest challenges they face as operators. And we're very excited to be their partner.
Adina, this was great.
Great, thank you.
Thanks for catching up with us. Adina Friedman there of NASDAQ on the future. Lisa, I'm moving away. I think remodeling the company from the company that we all knew 10 years ago, exchanges, listings, all of that, to something different.
To a financial technology company that's more comprehensive. It kind of goes to the question that you were asking Jose Minaya about this idea of, are we moving to having a bite of indexed funds and then a bite of something else, and sort of how the financial market is getting more complicated and more rounded. And I think that that's, in terms of not only private markets, but also financial technology services. I just think it's an interesting moment for a lot of different firms and how to orchestrate that.
Well, you mentioned the concentration. Because of the concentration, there is a belief that you have to go elsewhere for opportunities for diversification, which is why you're seeing this real hunger, this push to go into profile markets, which you just hear non-stop.
Yeah, which raises a lot of questions, and we'll have to explore them.
I'm with you. We'll explore some questions with Pat Gelsinger, the CEO of Intel. That conversation is coming up next, live from Davos, Switzerland. Good afternoon.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money, and number 2, don't forget rule number 1.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action at a new time, 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
This is Bloomberg.
Of jobs in advanced economies over a foreseeable future are going to be impacted by artificial intelligence. If you're lucky, artificial intelligence will enhance your productivity, make your job more enjoyable, and very likely better paid. If you are unlucky, your job is gone.
Such ugly environs.
Kristalina Georgieva there, the IMF Managing Director, sitting down with Bloomberg's Lisa Bramwitz a little bit earlier on today. How did that go?
It was really interesting, actually. She had some wonderful words about Bloomberg. We'll talk about that another time. But I will say...
Did she actually have some wonderful words?
She was joking around about how artificial intelligence could make it sound like she was saying that, Bloomberg was terrible, and then proceeded to, continue to discuss that. But no, she was joking around, of course, obviously. My point was, I think it was really interesting to hear what she had to say about what Christine Lagarde had said about Donald Trump. And she said, American people could do whatever they want, they vote, etc. If you look at his policies, they're there might be some serious concerns. So that was some sort of undertone as people try to sift through the uncertainty of Donald Trump being president again.
What might those concerns be for the International Monetary Fund?
I think that a lot of the protectionist or the sort of more inward-looking, the tariffs, things of that nature, the less globalized kind of view on the world.
The question I would ask about that, have things changed under this administration from the previous administration? The rhetoric is different. The bedside manner is maybe what you might expect from the White House, but ultimately has the policy changed?
Well, he hasn't gotten rid of NATO. I mean, there are some particular issues.
The tariffs are still there, though, right?
It is fair. I think it's a fair point. The question is, are we still on this trajectory of more nationalist types of measures?
We'll have more conversations about that through the week, no doubt. Just want to touch base with the price action just for you going into the opening bell in about 42 minutes, something like that. Earnings from the big banks. Bramo essentially behind us now. Goldman, Morgan Stanley this morning. Can we say there are any shockers? I can't think of any shockers.
There are no shockers. To me, the biggest shocker was Howard Lutnick coming on and saying, it's going to be an amazing year. Just ignore all of the negative talk. It's going to be a great year. So maybe that's more of what we can expect.
And the aggressive pushback against rate cut calls as well has just been a dominant theme of this morning.
Absolutely. People basically saying you either get a soft landing and very few rate cuts or a hard landing and many more rate cuts.
We've got a fantastic guest with us on set, not to talk about rate policy at the Federal Reserve. Pat Gausinker, the CEO of Intel, does not want to do that. Pat, good afternoon. It's good to see you.
Good afternoon, Joe. Lisa, great to be with you today.
No questions on Chairman Powell. No questions on Chairman Powell at all. Talk to me about deglobalization. How compatible is deglobalization with the chip industry in its modern form?
Well, ever since we started this journey of bringing the U.S. chips and the EU Chips Act to place, it was all about building resilient supply chains. And we said for something so critical, and I ask all the time, what aspect of your life is not becoming more digital? Well, everything is, and everything digital runs on semiconductors. And through COVID, we saw the fragility of our supply chains. We're one port, one island, and because of that, we said we need a balanced supply chain for the world. And that's what we're off to do, is to rebuild the Americas and the European supply chain for semiconductors. So, hey, we're all better off, right? We have better jobs, we have better national security, better economic, and we're ready for a turbulent world. And with 2 wars active today and, different countries and, different political and geopolitical concerns, this is critical for the future.
Let's talk about the CHIPS Act. Can you just walk our audience through, particularly the audience outside of the United States, what that is, how big it is, and whether you've actually received anything from it yet?
Yeah, so the CHIPS Act, $52 billion. Some of that was capital offsets. Some of that was long-term R&D, and it was paralleled by the EU CHIPS Act, right? It was about 45 billion euros, so very similar constructs. And what it was saying, we never voted to get rid of this industry, this critical industry for the future, but Asian economies voted to get it. And as a result, we're no longer competitive in U.S. and in Europe. So let's create a leveling, and long-term incentives to invest in this industry. And that's what the CHIPS Act is doing. And, Commerce set up their department, DG Comp for the EU Commission is now underway, and we have projects in the U.S. and projects in Europe to take advantage of that. And they're in the latter stages, right? And as I say, boy, I'm ready. I'm building factories today. Let's go.
Can you quantify, though, to John's point, how much Intel is receiving from the CHIPS Act? Can you quantify how much cheaper it really would make manufacturing in the U.S. for you?
Well, what we said is, and, industry analysis like the Semiconductor Industry Association in the U.S., similar studies done by BCG and others have said it's 30 to 40% cheaper to build in Asia, right? Because of, taxes, tariffs, incentives, labor, the supply chains. And the CHIPS Act is designed to close that gap. So if you're building a $20 billion facility, you're 30 to 40% uncompetitive without some of these economic capabilities being put in place. And that's what the U.S. and European CHIPS Act are doing, bringing those so that when we make enormous, and these facilities, and the one we're doing in Germany, is well over 30 billion euros. This is huge, and I can't be uncompetitive to that degree and expect to compete in the world market effectively.
There's a question when you talk about supply chains of the foundry that you're building and who's going to be building their chips with you, right? It's not just about your chips anymore. Have you had any real conversations with the Amazons of the world, with the Apples of the world, with NVIDIA about manufacturing some of their chips?
Yeah, we've had lots of conversations with them, and we've started to close design wins with different ones. And for the most part, it's not the industry practice for them to say their name because they already have relationships with others in that regard, and they somewhat view it as competitive intelligence as well. But as we've announced, we now have 3 major foundry customers for our most advanced process technology. We've now announced multiple advanced packaging customers as well. And my earnings call is next week, and we'll be updating on both of those as we come up on the earnings call. So we're making good, solid progress for industry engagement. Potential customers as well. I'll say momentum is building for us to become that Western foundry for the world.
The political attention this industry has gotten over the last few years has been phenomenal. I remember when Rex Tillerson got the job at the State Department, coming off the back of his work at Exxon, and there was a view that he was the ultimate diplomat because he had to deal with governments all around the world. And I now think of people in your industry as the ultimate diplomats. Have you had to become a politician over the last few years?
Well, my day job is running Intel. And, with that, making sure we rebuild our process leadership, our product engineering, rebuilding our customer relationships. But I've had to spend a lot more time in Brussels and in the Capitol Hill, right, on these topics than I certainly would have envisioned, right, when I took the job. But it's been fulfilling as well, because I think we've created the 2 most significant pieces of industrial policy since World War II. We've accomplished that in the last couple of years, and I think fundamentally we are rebuilding the supply chains of the West. I'm proud of that.
Well, you talk about Europe, and you mentioned building in the U.S., and you threw Europe in, and I kept wondering, where's the European Chips Act, right? How much cheaper is it to develop in the U.S. now than the Europe? How much does Europe lack that competitive edge that it might have had?
Yeah. The gaps between U.S. and Asia and Europe and Asia are similar. Right, and this 30 to 40% is sort of a good thumb in the air, for that competitiveness. And we're not trying to say it's U.S. versus Europe. It's U.S. and Europe to be competitive with Asia. Because if we were here in 1990, 80% was built in U.S. and Europe. Now it's 20%.
But Europe doesn't have a CHIPS Act, and so I'm wondering.
Oh, it does.
Okay,
the EU CHIPS Act.
Does it commensurate your? Does it compensate
Absolutely.
you enough? Okay.
Absolutely. We feel good with that, and our proposals for Poland and Germany, the 2 big projects that we've announced will soon be going through the DG Comp process. I just met with Commissioner Vestager last week, and we discussed those proposals coming forward from Germany, bringing it forward, and Poland bringing it forward. So, we're expecting those to come to fruition quickly and get the big, Magdeburg project underway and the big Wrocław project underway. We're quite excited, and it builds on what we're doing already in Ireland, right, which is making good progress, and what we're already doing in Israel.
Pat, it's good to see you. Thanks for catching up with us.
Hey, thank you so much. Always a pleasure to be on Bloomberg.
Thank you very much. Pat Gaussinger there of Intel, the CEO of Intel and the ultimate politician, I guess, as well, which is what's happened to that industry over the last few years.
You have to be, because this is the new arms race. It is
Absolutely.
the chips race. It is the technological race, and it has to do very much with the hardware as well as the software.
So we're going to round up this program, and I believe Manus Cranny is going to take you to the opening bell in the next hour on Bloomberg TV. In the next hour, though, we'll be back. We'll be catching up with Mike Wirth of Chevron, and we'll no doubt be talking about politics and policy, not in the White House, but from state to state, California to Texas.
Which we've seen in massive ways, talking about leaving California because of some practices that make it a lot less profitable. Interesting kind of dynamic. We've seen this with people moving, too.
Big time, big time. I wish I could, but I'm not sure I'm able to. I'd go for the taxes.
Yeah?
Yeah, without a doubt. Coming up on Bloomberg TV, Mike Wirth, CEO of Chevron. I think I just did. From Davos, Switzerland this afternoon. Good afternoon as we wrap up day 1. More still to come throughout the day on Bloomberg TV and Bloomberg Radio.
Leadership is much more than a flotilla of financials and numbers. Naftali Holt showed me around the celebrity beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From New York City, for our viewers worldwide, I'm Manus Granny in for Jonathan Farrow, as there's a chill across New York this morning. So a review on the equity market. We drop as the rates market, well, it recalibrates the trajectory for cuts. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, brace for a busy week of Fed speak and economic data. Trump takes Iowa, moving closer to a rematch with Biden, and the bank earnings continue with beats. Goldman Sachs and Morgan Stanley. Let's begin with the big issue, election risk returning to the street.
This is the year of the election.
An election year. Election year. U.S. elections. The election does present some interesting risks to the economy.
It's a major of uncertainty.
It's likely to be rocky, shall we say.
It's like a spectator sport. Likely candidates for either a Biden or Trump.
We'll see, how much of an impact the potential Trump-Biden race has on things.
At the moment, it doesn't look terribly interesting for markets.
Neither of those candidates, in terms of what they're telling us, are really going to change that longer-term trajectory.
Either the Republicans or the Democrats are going to be very much constrained in terms of fiscal policy.
Focus on how the upcoming election, and importantly, the uncertainty around the election outcome, whatever it may be, could impact the confidence of consumers.
You're going to get a lot of swings.
You will have volatility.
You have an election year in the U.S. that promises to be, bizarre.
Joining me now from Iowa is Bloomberg's Kaylee Lyons. Kaylee, trade, tariffs, all of these issues, we'll talk through them in the next hour, but you've had a long, cold night, but it came up for Trump.
It did, and that isn't all too surprising, Manus. He came away here in Iowa with 51% of the vote. Ron DeSantis, who came in second, got 21%, and Nikki Haley, 19 in third. She won one county here in Iowa. Donald Trump won the other 98. He almost had a clean sweep of all 99 counties here in Iowa. Again, we thought he would win. What was surprising, though, was how quickly this race was called for him. Just about 30 minutes after the caucuses began is when the Associated Press and other major networks called this race for Trump. Ron DeSantis' campaign has called that election interference. I'm sure that is a story we haven't heard the end of, but what these networks and the Associated Press said was that it was just clear very early on that no one was going to be able to catch Trump. This really cements his status as the frontrunner in this nomination campaign and his status, frankly, as the presumptive Republican nominee. That said, it isn't over yet. 1 week from today is the New Hampshire primary, and former UN Ambassador Nikki Haley is significantly closer to him in polls in that state. In recent polls, it shows she's in single digits, so we could potentially see an upset there. One factor to consider, though, is Vivek Ramaswamy, who came in fourth here in Iowa last night, has now left the race and endorsed Trump. He was polling in the low single digits in New Hampshire, but the thinking is whatever votes he would have gotten there will just go to the former president, so that could make him more difficult to topple in the first in the nation primary state. If he is able to win New Hampshire, as he did here in Iowa last night, it is very difficult to see how anyone else, Ron DeSantis or Nikki Haley, would have a path to the nomination. If he wins the next contest, it is highly likely that what we see in 2024 in the general election is a rematch between Trump and Biden. Manus.
Katie, thank you very much. Great reporting by yourself and the team over the past 24 hours. Onwards to New Hampshire. Joining me now is Isaac Boltanski, BTIG. So here we go. The headlines roll in. It was called in 30 minutes. Euphoria for the Trump camp. You would say, hold your horses and wait for New Hampshire. Talk me through the reasoning.
Yeah, look, I think that this was an expected outcome. We can look below the surface, and there are some interesting dynamics that I think are meaningful. In particular, these contests tend to catalyze consolidation. And I think what the Trump campaign is loving this morning is that Ron DeSantis won second place, which means that he's going to continue on into New Hampshire. And that means that the opposition to Trump remains fractured. And as long as that opposition remains fractured, as long as we don't see it consolidate around a single candidate, that's good for the Trump campaign. Furthermore, you obviously add that Vivek left the campaign. And look, that's not nothing. He got 7% of the vote in Iowa. So that was a meaningful night for the former president on two different fronts. New Hampshire, to me, is far more meaningful, though, because New Hampshire has been a better predictor of who ultimately gets the nominee. If you look back at the 7 past primaries for the GOP nomination for president, New Hampshire has accurately predicted with their vote 5 of the past 7, whereas Iowa has only predicted 2 of the past 7. And part of that has to do with the caucus dynamics. Part of it has to do with the voter base being more moderate in New Hampshire. But look, I truly think New Hampshire is the big race here. And if Trump wins that, he should really finish up this whole primary by Super Tuesday.
The legal attempts to bump Trump off the ticket, 17 states are still working through whether they will confirm Trump or not, and we have 4 federal cases pending. 2/3 of the voters in the GOP saying he would still be fit for president. These legal issues just don't even stick, do they?
It all comes down to the way that primaries work. And primaries for each party bring out the strongest extremes of those ideological spectrums. And that means that the folks who are going out to caucus in sub-zero weather in Iowa, or who are going to the primary in New Hampshire, they are strongly ideologically aligned with the core of the base. And for that reason, there are surveys suggesting that 1/3 of GOP primary voters are going to vote for Trump no matter what happens on the indictments, or no matter who is running against him. And for that reason, coupled with winner-take-all primaries becoming more and more prevalent, this is Trump's primary race to lose.
Okay, so that's the building consensus. You could have a rematch of Trump-Biden later this year. How far behind and out of the court and misjudging are the Democrats of the current election they're facing?
Look, we're still in a phase here where traditional DC is arguing that there's a pathway where this is a race between anyone other than Trump and Biden. There is still a fair amount of hopium that you hear in political circles here in town, but I think the base case is that it's going to be Trump v. Biden. And man, to me, the most important thing here is that you can have as many opinions as you want about how this is going to go, but it's going to come down to about 7 states. And we have to remind ourselves that the last election, 2020, was decided by 44,000 voters in 3 states. You add in the complication with third-party candidates and other dynamic issues such as the economy, and it's easy to see that this is a pick-em.
And that's based on the presumption that it is Biden on the other side of that ticket. Isaac, thank you very much. Let's see how it plays out. That's Isaac Boltanski there on the analysis of the Iowa caucuses. Let's talk about the market implication. We have double lines, Jeff Sherman and Sonal Desai of Franklin Templeton. Here we are, political risk. Neither of you really want to talk about how that plays out in markets so far out, but let me take it to you first of all, Sonal. It's about the risk of tariffs, the risk of fiscal. It's about the risks of maybe what comes if Donald Trump is on the ticket, and then if he wins. Is that how I've got to concern myself from a market perspective?
Can I take a slightly contrarian view here?
Of course.
I'll just note, you know, we all talked about tariffs under Trump. Not one of those tariffs has gone away. And we are over 3 years into the current administration. And I doubt very much that the tariffs will go away under the next administration, regardless of who comes into the White House. So that's number one. I'd just say, you know, there is no difference here. Tariffs seem to be remarkably popular in the US right now. Yeah. It doesn't matter. The other piece is fiscal. Again, if you just look at the mini agreement that the Democrats and the Republicans made, it came out with one overarching feature, $70 billion higher in fiscal spending, lower taxes and higher expenditure in this coming year. Again, neither the Democrats or the Republicans have the stomach for fiscal consolidation. I don't think there's much to choose amongst the two of them.
Maybe they just need to jettison. Maybe the Democrats need a Kennedy back on the ticket, and maybe the Republicans need something else to challenge them. By the way, Bloomberg have run the numbers. 10% tariffs are bad news for 45 states. But you know how much it would knock GDP by? I was shocked by this. Only by 0.3%. It's a vote winner, not a GDP killer. Jeff Sherman, good morning. First take, a runaway train. It's called Donald Trump. There's a long way to go. How do you look at the year ahead? Will politics revolve for me? Let's just take it from that perspective. Good morning.
Good morning. Yeah, it's quite difficult to see much difference, as Sonal just pointed out, that just go back and look at the deficit expansion that we saw during the Trump administration, see it during the Biden administration, go back to the Obama administration. Do you see a trend here? It really doesn't matter what the letter that the candidate is running with, that we've just seen this massive deficit. And so I think really from the standpoint of the fiscal side, I'm not sure it really matters unless we're going right into the election. Okay. And let's say we had a hiccup in the economy and effectively Congress will not let something go through. And so I think as we talk about this political landscape, and we're going to be talking about it for the next 10.5 months, I think that there really isn't much difference to markets at this stage. And so looking forward, I think we're going to go back to just looking at the strength of the overall economy. Markets themselves are really focused and very myopically focused on the Federal Reserve today. And I think that's going to be the thing that's going to set the course for markets for the next couple of months, and not really who are these presumed candidates on either side of the equation.
Yeah, it's going to come down to whether it's 3 or maybe even 6 rate cuts and why we're getting the rate cuts. Right. Okay. You're going to stay with me. That's Jeff Sherman and Sonal Desai. They're going to talk through markets in just a moment. Let's get into what's going on under the hood. We've had some reporting before the bell. Katie Greifeld is with me. Katie, what have you got?
Let's start with Tesla, because CEO Elon Musk really leaning on the board here for more control at the EV maker. He said on X that he would want roughly 25% voting control at Tesla to build our AI and robotics products there. If not, he'd look elsewhere. For context, he's Tesla's biggest shareholder, with an almost 13% stake. Tesla shares down slightly. Let's move on to Goldman Sachs. Of course, reporting earnings today. It's down slightly despite beating profit estimates at the bank's equities and tradings unit. The revenue jump there was triple analyst expectations. It's worth noting, though, that fixed income trading and investment banking fell short. And let's end with Apple here. Two stories. Planning to remove blood oxygen features from its latest smartwatches, really to get around a U.S. ban of the devices if an appeal of that decision fails. And you also have Dow Jones reporting that Apple is offering discounts on newer iPhones in China. We know that demand is a big concern there. Apple shares down about 2% pre-market.
Okay, Katie, thank you very much. Wrapping up the stocks under the hood. Coming up on the show, guess what? The rate cut debate, it moved to Davos.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening. We'll get 2 or 3.
It's a busy week for the Fed with the speakers coming up. Waller kicking things off at 11 a.m. That conversation coming up on Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money, and number 2, don't forget rule number 1.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. New time starts Monday.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening. We'll get 2 or 3. But there is a chance. I've said the one thing we can probably be sure of is that whatever the consensus is here, and not just here, it's going to be wrong. And if we get a deep recession, and definitely it could happen. How's it going to happen? I don't know, but 25% chance it happens.
Former IMF chief economist there, Ken Roller, weighing in on, guess what, the rate cut bets. And the debate over the FOMC's path is heating up. Investors are watching the data this week, including the Fed's Beige Book, retail sales, and more. Meanwhile, we hear directly from the following Fed officials, including Waller and Bostic, on the U.S. economic outlook. Bloomberg's Mike McKee is with me. Kicking it off, Mike, I was just looking at New York. We've got the Fed Empire Index crumbling.
The Empire Index crumbled, but unfortunately for those who want to see that as a sign, the 6-month numbers out. Condition 6 months from now, all the numbers went up for that. So the question still remains, with the numbers that we have coming, if CPI didn't change people's minds about 6 rate cuts, what possibly could? Big number of the week comes tomorrow with retail sales. We'll take a look at that and see if people spent during Christmas time. Also, the Beige Book tomorrow will give us an idea of what CEOs and companies are telling members numbers of the Fed. Industrial production, see how things are going, whether Empire actually reflects what's going on. Thursday, we got housing starts and jobless claims, the Philly Fed. And then on Friday, we get Michael Barr and Mary Daly. You saw the other Fed officials scattered throughout the week. Daly gets the last word because when Friday's over, the Fed goes into the blackout. We won't hear from them. And so far, we haven't had to. They've said they're basically going to be on hold, and we haven't seen numbers that have changed anybody's mind in Wall Street about that. Nobody thinks they're going to move on the 31st of January, but a lot of people still, 75%, think they're going to move in March. And December of 2024, the feeling is we're going to see 6 rate cuts still, almost 7 by that time. So what is it going to take? We do have a lot of other data coming up, even before the next Fed meeting. December GDP, PCE inflation next week, along with the fourth quarter economic employment cost index. Those could make a difference, but probably not. Then the payrolls and CPI and PCE inflation come back in many different forms during the interregnum. We have the next FOMC meeting on March 20th. So it looks like status quo for now in both the economy and the Fed forecast from futures. The question is, what would it take to change any of that? Will any of those numbers, Manus, make a difference?
Yeah, the ammunition. Does the Fed have the economic data information, ammunition, to actually pull the trigger in March? Mike, thank you very much. Mike McKee with the very latest analysis of your data slate ahead. Jeff Sherman and Sonal Desai are with me this morning. I love what Rogov says, which is, you know, it's a pipe dream to think that you're going to get 6. He doesn't really know whether you're going to have a soft landing. I mean, it's very candid and very, very honest. Jeff, let me take it to you first of all. My understanding is that the options market has coalesced around 2 to 3 rate cuts. It's only us in the media that are obsessed with 6. What do you make of where the market is positioned for in terms of rate cuts 2024?
Yeah, I mean, I think right now the market's a little optimistic on the rate cutting cycle at this point. And I think Professor Rogoff is doing it the right way to say, you know, kind of the consensus is more like a 3, as you said, it's inferred from the options market. But it's that tail risk that's really driving those incremental 3. And so I really don't think that a soft landing is one that predicates having 6 cuts. In fact, if it is a somewhat soft landing, maybe it's a bit slower to recognize those cuts because with a soft landing, potentially there is a little bit more of inflation out there. And so, you know, we saw that from the uptake in the inflation data a little bit last week. As you mentioned, it really didn't do much to the overall pricing of markets. But this idea that we have this Goldilocks scenario is just something where I think the market is really trying to price the ability to have that optionality. It's like, it probably won't be 6, maybe it's 3, maybe it's 9, maybe it's 12. And obviously those would be very hard landing scenarios to get to those 9s or 12s. But at the end of the day, I think that what you're seeing is that there is divisiveness out there in the data set. You're seeing a mixed bag in the overall data. You're seeing some form of slowing. Okay. And so the market is prodding the Fed along to do those cuts.
Well, at the moment, we've got 6.47 rate cuts penciled in. So now, I like your style. You've come with swag. You just say, look, it comes down to Powell, this newfound lack of prudence. They've only themselves to blame for this market becoming slightly more delusional about 6 rate cuts.
Yeah, absolutely. I mean, look, the Fed did not need to do this. The market was easing for them already, and then it went off on power thrusters, right? In the sense that it is this remarkable internal cognitive dissonance now inside the markets, because if you look at if you look at risk assets and fixed income, whether it's equities, fixed income, the riskier parts of the spectrum, they are not pricing the type of hard landing that would be required to get that 6, 7 rate cut scenario coming out to play. So essentially, this is almost a sentiment-driven rally off Powell's press conference, and I would expect that the Fed is going to have a rather tough time putting that genie back into the bag again.
Well, they're desperately trying to do. Yeah, they're desperately trying to do that. Let's see what comes from Fed speak before the end of the week. Can I ask you both to set out your risk stall respectively? I had a conversation with UBS this morning, Banu Baveja, and he said very clearly, risk premia increases. Disinflation will continue, but risk premia will increase. In that case, Jeff Sherman, where do you want to be?
Well, you want to be in the middle of the stack in terms of credit quality. As Sanal said, you're not seeing the repricing in the lower tier of credits at this point, reflective of those kind of weakening in the economic data set. So it's that upper to middle tier of credit. If you want to take risk, it's probably in the double B area, maybe at the higher part of the single B area. But again, the pricing's been reflective of all these rate cuts in there. So in general, I think being good enough right now in this market with credit is the place to be. Spreads are relatively tight on these levels as we had the everything rally over the last 12 weeks. And so I don't think it's time to be a hero and be delving down in the risk spectrum. If anything, use this as a way to trim some of those exposures and try to migrate up a little bit in that quality. But again, you shouldn't be fearful of the aggregate risk in the overall credit markets right now.
So Sanal, you want to take a little bit of duration, but is that predicated on the same thing? Risk premium increases, and it's a form of hedge.
It's a form of hedge. And the other thing I would note is selectively, actively selecting pockets of risk. Yes, clearly, in our baseline, where you don't have that massive recession, risk assets which are not fully pricing in six rate cuts.
Sanal, in a very, very, very quick last 15 seconds, where would you take the biggest risk? I get the hedge, but where would you take the biggest risk?
Biggest risk is in, exactly as Jeff put it, better quality right now.
Okay. That's the team we've assembled post-Iowa. Don't worry, I'm sure you'll be back. We've got New Hampshire to get through and a heck of a lot more. It's my first U.S. election to live through in the States, so I'm excited. Jeff Sherman, Sanal Desai there on the markets. Coming up, your morning calls. And later, Chris Harvey from Wells Fargo unveils his outlook for the earnings season. Have we downgraded our outlook so viscerally that the bar to achievement is really quite low? This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond. Time for your morning calls and look at what some of the analysts are recommending. First up, Morgan Stanley upgrades target to overweight, pointing to an attractive valuation and a constructive setup. Next up, Wells Fargo downgrading Boeing to equal weight, expecting limited upside as the FAA takes a closer look at its operations. And finally, Mizuho downgrades PayPal to neutral, sees competition and headwinds forming from Apple Pay and Zelle. That's if you can find a restaurant that takes your Apple Pay at your table. Coming up, the banks are under pressure despite a pair of beats. That conversation up next with Chris Harvey of Wells Fargo on Bloomberg.
all this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time where we'll be fully transparent on viewing data.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action at a new time, 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Down to the market open. Now, we originally had a little bit of a bid in Goldman Sachs. Morgan Stanley was a little bit more tepid, but that bid for the banks has dissipated. Futures are lower, waiting for the opening in the cash market. The rates market is reviewing the trajectory, and as Ken Rogoff said, if you're thinking that you're looking for 6 rate hikes and rate cuts in 2024, that's a pipe dream. Okay, that's state of play on the equity markets for you. We're rolling down ahead of the cash session. I can tell you Morgan Stanley is down 2% in that opening bell. Euro dollar is down. The dollar is the driver. The dollar is the alpha in this narrative. It's at a 1-month high as we go into this slightly more risk-off trajectory. We caught up with Mr. Villeroy this morning. He said the ECB will very probably cut in 2024, but rate cutting is a game of tennis, not soccer. 10-year yields rise and undo some of the momentum that we saw on Friday on the back of the PPI, and oil is flat and utterly ignoring the escalating situation in the Red Sea and Iran against a number of its counterparties. One sector to watch is the financials, as I said to you. Goldman Sachs, Morgan Stanley moving lower despite the better than expected numbers before the open. Katie Greifeld has the dissection on the numbers. This is about cost cuts for one and IB for the other.
I will say you're not seeing it in the shares right now, but Goldman Sachs is starting to get its mojo back. The bank's equity unit generated $2.6 billion in revenue. That is a 26% jump. Analysts had been looking for 8%, so blowing away estimates there. Elsewhere in Goldman land, you saw its asset and wealth division post its highest quarterly revenue in 2 years, helping to offset some disappointment in fixed income trading and investment banking fees. So Goldman down slightly, or a little bit up now, right now, and Morgan Stanley obviously falling right now. The bank's wealth business, it beat expectations. Can't say the same for trading, though. Fixed income trading basically flat from a year prior, and while Goldman's equity traders shined, Morgan Stanley team totaled $2.2 billion in revenue. That is below expectations, Manus.
Yeah, well, those medium bond traders in FICC certainly was a miss at Goldman's. Katie, thank you very much. Let's stay with the banks. Of course, we got more qualitative information on the earnings call. Shonali Basak was on those calls. What did you learn? Shonali, good morning.
Good morning, Maz. We had Morgan Stanley kick off, and of course, it is the first earnings call for CEO Ted Pick. Now, remember, Morgan Stanley was trading among the richest of the big 5 banks, the big 6 banks, and so you are seeing them sell off this morning. They're saying net interest income in this current quarter will come in line with where it was the prior quarter. And of course, as Katie was talking about, there were some questions about this trading performance here, because not only did they miss, Manis, if I told you that Goldman last year brought in more than $1 billion more in equity trading revenue than Morgan Stanley, you wouldn't have believed me just a couple of years ago. So it is showtime for Ted Pick, and there are a lot of questions about the strategy moving forward. Analysts grilling him about the future. When you looked at the presentation as well, same targets, new CEO. The targets, however, did not have that normal plus or minus that they did around those targets. So analysts looking for Ted Pick to push the bar higher while maintaining competitiveness.
Janali, I believe every single word that comes out of your mouth. Janali Basak on the banks. You are the Bible on banks. Let's turn our attention back to tech. Tesla slips as Musk says he wants more control before building up the company's AI products. Is that really the reason that they took 2.25% of a chunk out of the stock this morning? What are they worried about, Ed Ludlow? Good morning.
It's not the reason to Elon Musk's mind. The reason to his is that he wants an appropriate amount of voting control within Tesla's board. The stock is down 2.6%, adding to what has already been the worst start to a year for Tesla since it's been a public company. Prior to this morning's open, it shed $90 billion in market cap. So Tesla's board can't negotiate with Musk because there is litigation ongoing, or at least the verdict has been reached in a Delaware compensation case. But the verdict's not been reached in a Delaware compensation case. Musk's argument is that if he has 25% voting rights under a new compensation agreement, and he would be open to a dual class of share structure, which is hard to do after you've already gone public, then there will be more balance in decision making. Anything below 25%, he thinks that it leaves the company at risk to different points contrary to his own, which could bring in takeover interest and other things. Read the Post, there were many of them.
Yes, there were quite a few. Thank you very much. The stock trades at 212.71 at the moment, down over $6. Let's stick with tech. Apple is planning to remove the blood oxygen tool from the latest smartphone watches. Now, this is to avoid a ban here in the US. Isabel Lee has the details. So this is called a pragmatic response or disaster recovery scenario. Isabel, good morning.
Good morning, Matt. It's pragmatic indeed, but before we get to that, we do have headlines just in. Apple rejected by Supreme Court an Epic App Store suit, and Apple must change App Store rules that bar developer links. But going back to that pragmatic decision that you said, so the redesign is definitely to work around that import ban. At the heart of the dispute with Massimo, which is a tech firm in Apple, is really the blood oxygen sensor. So in October, the ITC said that Apple has violated Massimo's patents, and in response, Apple had to pause sales in December, which is a busy season. But last week, Apple presented its redesign, and we have the U.S. Customs and Borders Protection, which is in charge of enforcing the bans, approving. So this means that Apple will keep its watches in the markets. There are still many moving parts, but it remains to be seen. For now, shares are down 2%, Manis.
Yeah, and that is a red headline for anybody, as you just say, tuning in. The Supreme Court rejecting Apple's request for an Epic App Store review. Isabel will track this story. Let's turn our attention back to the banks. Chris Harvey of Wells Fargo, which rates the financial sector as neutral. Good to have you with me. So Goldman's are in. You got Morgan Stanley, the wealth unit beats. Goldman's looks as if the worst has passed for Solomon. It wasn't a bad Friday for the banks. Why are you neutral?
We're neutral because the fundamentals, right, we're not in the right part of the cycle. At least I don't think we are. Typically, you want to get involved in the banks and some of the capital market players when you start to see the credit cycle unfold a little bit more aggressively, right? We really haven't seen that credit cycle play out just yet, and there's a lot to come. So while valuation looks good and the fundamentals are okay, there's nothing there that says, wow, we've got to buy them right here, right now. The other thing is a lot of the mid-cap banks have really performed quite well off the low. I think they're up 30, 35% off the low, and now's not a great time to step in.
Now, in terms of just stepping back from this market, as you said, we've got time. You can see how the rest of the year plays out before you step into the financials. But this is what you're saying about risk. You feel that the market is a little bit too complacent, and we expect to step up in vol on market stress. So again, my very simple question to you is, how much of an injection of risk premium do you expect to see, and where is that going to pop?
Yeah, so Manis, this is a great question. One of the things I think we're seeing right here, right now, is the situation the situation that's playing out is fundamentals are okay. The macro is fantastic, right? So rates are coming down, credit spreads are tight, everyone thinks the Fed's going to cut early and often, but the micro or the idiosyncratic is just okay. The other thing is we're starting the year, you had a heck of a year last year, right? You're up 20, 25%, depending on where you are in the stock market. And if you're running a company, if you're in the C-suite, you really do want to manage expectations as you report fourth quarter and you start looking to 2024. So you want to bring them down. And so again, the setup just isn't right. And as people start to moderate things, and as we start to get to the fundamentals and realize the fundamentals aren't great and that handoff from the macro to the micro is not quite there, we can see risk starting to go up.
So the debate is this. We just don't know how hard or soft this landing is going to be. But there are some big consensus trades, and they are around the Mag 7. And the thesis has been that Mag 7 could turn into Lang 7. When it comes to technology, you get idiosyncratic days like today with Apple and Tesla. But as you look at tech, why do you prefer software to hardware?
Right. So Manus, what we want to do is we're a little bit more conservative. We also like certainty, right? If you look at the software space, you get a lot more certainty. You get a more certain earning stream, right? You get fundamentals that are a lot more stable. Furthermore, the technicals look a lot better on the software side than they do on the hardware side. And so we think the technicals and the fundamentals will probably cause the software space to outperform the hardware space, and you're beginning to see that.
I'm looking at the bond market. The bond market, I mean, the gyrations are pretty intense, aren't they? Friday, it was full bull with the PPI down 10 basis points on the short end. Then we resurrect our fundamental fears that the Fed may not deliver. When you look at the bond market, is it a hedge for you? Will 2024 be a year where you touch duration as a hedge? And if so, to what extent?
Right. So Manus, one of the things we're looking at in the bond market, one of the things that really concerns me at this point in time, is you're beginning to see the 2-year melt, right? On Thursday and Friday, the 2-year is down 10, 11, 12 basis points. Like, I can understand that reaction on Friday, but not on Thursday. And you're now over 100 basis points below effective Fed funds. The last time we were in these levels, or you saw this kind of inversion, was September of 07 and late 2000. Those weren't great times, but here's the funny thing. Back then, the underlying fundamentals for the economy and for the market weren't great. You had credit spreads widening at a pretty aggressive clip. Here, credit spreads are actually tightening. So there's a lot of really conflicting signals in the marketplace, and it's a little bit confusing. But if you ask us what we're looking for in the bond market, we're watching that 2-year, because if that keeps coming down, it doesn't matter what the Fed says. The market is telling you that the front end is just way too tight.
Well, I was with the CEO for Moet Hennessy on Sunday at the Javits Center. I mean, that was a sort of a surreal experience in itself. So we talked about champagne, and then we talked about pricing. And he didn't think he was going to be able to eke out any more aggressive price hikes. Okay, high-end luxury booze is not reflective of the whole market. But I'd ask you the same question about pricing. Is that ability to really push through price hikes fading? And what are the consequences on the stock allocation?
Yeah, so a little while ago we were talking about the risks. And one of the other big risks, and I should have mentioned it then, is pricing, right? I think what's going to happen is we're going to see a lot of price discovery. And what I mean by that is a lot of companies are going to discover they don't have the same pricing power today that they had 6 and 12 and 24 months ago. And the reason being is very simple. The supply chain has normalized. Supply and demand has come back into alignment, right? Because of that, it's very, very difficult to have extraordinary pricing power. And so as a result, I think what we're going to see in the start of the year is people realizing, the market realizing that pricing power, just that strong pricing power, no longer exists. And that's going to cause potentially another repricing of risk.
And the implication for the PE multiples then, I mean, is it that I just look at those consumer-heavy stocks, those consumption-orientated stocks? Is that where the dissipation is going to be, or is that just too easy a lean?
You mean as far as pricing, Manus?
Yes, as far as pricing is concerned.
Yeah. Okay, so what we're seeing, what we've been seeing is it started in the staple space. We started to see pricing growth beginning to decay. And then what we also saw is we saw demand destruction. That has brought out just from the staple space to materials, to parts of the industrial space, to more consumer spaces. So it's getting pretty, I can't just say it's one sector, it's getting to be pretty widespread, and it's getting to be a concern. And this is one of the things that we're focused on, not just management of guidance as we go forward, but how strong pricing is as we go forward. And maybe that's one of the reasons why the 2-year is beginning to slide. Maybe the market knows something that we don't with regard to pricing and inflation. And we're looking at some of the data that's coming out of China, the deflationary data, and maybe that has something to do with it. But all still a lot of good questions. We'll find out a lot more during our earnings season.
How important is China? I mean, some of the hot headlines this morning out of Davos, where you have a reaffirmation of growth in China at around above the 5% level. Yeah. To what extent does China and its growth trajectory this year, the special bonds that they're issuing this morning, to what extent does that play into the equity narrative for you? Or do we live a little bit more detached from the China story than we have done in decades gone by?
I think we're a little bit more detached. Everyone's waiting for China to get out of this economic malaise that it's in. It just hasn't been able to happen. I think what's a lot more important at this point in time is the housing market. Right? We're seeing rates come down. We're seeing a lot of home builders rallying pretty aggressively. If you look at the multiplier of housing on the economy and on the labor market, it's quite strong. And so that's where we're placing our focus, not so much on China, but really on housing and what that can do to inflation and the economy.
Chris, thank you so much for being with me this morning. That's Chris Harvey, Wells Fargo. Coming up on the show, rising optimism for U.S. equities.
About the markets, we're looking at a market, equities, U.S. equities, that are breaking out to new all-time highs, double-digit growth for the next 2 years. That's pretty constructive.
For a conversation with Mike Wirth, the Chevron Chairman and CEO, right here on Bloomberg.
do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product because these products, these medicines keep people alive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Attention back to the World Economic Forum in Davos. Jonathan Ferro and Lisa Abramovich are sitting down with the Chevron CEO, Mike Wirth. Good morning, good afternoon, John, Lisa.
I've been told I've got to pick one, Manus, so I think we're going with good morning. We're going with good morning.
No, we went with good afternoon.
We're going with good afternoon.
Yeah, but it's okay. We're going on equal opportunity.
So now I'm just even more confused. Good afternoon, Manus Crony. Thank you, and good morning to Chevron CEO, Mike Wirth. Mike, how are you?
Good. Good morning, John.
It's good to see you. Fantastic to catch up with you. I think we have to start in the Red Sea. That's where the urgency is right now. Clearly, a lot of businesses have to reroute business. We saw that from AP Moller-Maersk, the container shipping giant, a number of weeks ago. Some breaking news in the last couple of hours on Shell. Could you give us the update for you and the team? What have you had to change, if anything at all?
Sure. We engage with the U.S. Navy and other security organizations for all of our movements to the Arabian Gulf, the Red Sea, and on every voyage we have a security plan, and it's really ship by ship that we evaluate the situation. So we're working very closely with the maritime security authorities. The risks in the region have been accelerating over the last several weeks. These are risks we deal with all the time. Last year we had a couple of ships attacked by the Iranian Navy. Actually, one of them was boarded and hijacked into an Iranian port. So this is a part of our business that we deal with. We take it very seriously. The safety of our people is the most important thing, and the risks in that part of the world are very dynamic and volatile right now.
Have you made any changes in the last few weeks?
We've made changes that we don't talk about publicly in terms of the security protocols. We have not made fundamental changes to how we've been moving ships over the last few weeks.
Are you surprised that we haven't seen any influence on prices whatsoever?
I actually am. That's an important part of the world for oil supply, and traditionally, when risks elevate in the Middle East, you see it reflected in markets. We've not really seen that yet, and so I'm a little surprised.
So what do you think it would take? I mean, do you think that the excuse that people use, which is that the U.S. is just overwhelming the world with oil, and that's the reason why oil prices have remained completely immune to any tensions in the Middle East, do you buy that story?
Well, certainly U.S. supply growth has surprised people to the upside, and I think it has helped calm markets a little bit. But it certainly has no ability to cover up a big disruption in the Middle East. That will fundamentally change the supply dynamics in the world if you were to see shipping halted, disrupted, or seriously disturbed. And so I do think that the U.S. supply has helped kind of calm markets over the longer cycle, but there's no capacity to respond in the short term to an interruption like that.
13 million barrels a day. Can we just sort of frame this just for a moment? How much potential is left? How much higher can that number go?
It can go higher. The U.S. is blessed with an abundant resource base. The constraints tend to be, right now, the capital spending of suppliers, how fast suppliers will go. A decade ago, companies in our industry were growing too fast in the Permian Basin in particular, and investors were unhappy with that. I think we've seen companies throttle back capital spending, return cash to shareholders more consistently. If they were to return to the ways of the past, I think you could see that number go higher. I don't see that going on right now, but the U.S. has upside.
Well, but this is the reason why people are wondering about the potential disruption. And I'd love it if you could quantify where we could see prices go if some of the disruptions that you're talking about come to pass, if the U.S. still has the ability to produce more oil, right? If there is the ability to ratchet it back up, couldn't that offset the disruption that potentially could happen that we haven't seen yet?
It could, Lisa, but not immediately. So between the time we actually have all of our plans ready to drill a well in the Permian Basin and when it comes on production, fastest is like 9 months. And our plans are set for years in advance. I mean, we've got it's a big system that you run to do this. And so there's not a light switch that says, okay, we had a disruption in the Middle East today. Next week, we can have more production in the Permian Basin. There's a lead time involved here. So you can see short-term dislocations in the market.
How much?
It's a very hypothetical question.
Give us a price.
Come on.
When we saw the Russia-Ukraine conflict begin, you saw prices well above $100. That's conceivable. If you were to see a significant disruption, Red Sea may be less than the Arabian Gulf because there's alternatives for shipping through the Red Sea. The supply that comes out from Saudi Arabia, Kuwait, Gulf producers that comes through the Strait of Hormuz, if that were to be closed down, that's a significant supply shortfall, which could really impact markets.
You delivered a big deal at the end of last year, I think 50 billion plus. Do you think the demise of fossil fuels is greatly over-exaggerated?
I think people have an unrealistic expectation for how quickly the energy system can change. The energy system is enormous. If you look at the overall mix of supply, 20 years ago, 84% of the global energy system was fossil fuels. Today, it's 81 or 82%. Despite all the advances we've seen in wind and solar and renewables and electric vehicles, the demand is much higher and the mix hasn't changed much. And so fossil fuels will be used for many years to come. Oil and gas will be used for decades to come. So I do think that there's been an underappreciation of the longevity that this business has.
A delicate question, slightly provocative. Does California have maybe a little bit too much confidence, hope that things can change that quickly?
Well, California's been on a path for a couple of decades to tighten up regulations, rules related to our industry to try to encourage other forms of energy. And we've certainly seen, we've got a large position. We made the first discovery in California back in 1879. We're really the only large oil company left in California. We've seen the investment climate change dramatically, and we've got a very large business there, but we won't be investing as much in the future because those investments just are less and less attractive because of the policy environment. And I do think that ultimately is to the risk of California and California consumers.
Has any politician reached out to you after you made your announcement to say, just kidding, come on back, we'll make things change, we'll make things easier for you? Did anyone reach out?
No, we have means through which we work on policy with the state of California, but these are decisions that have been long thought out. In fact, in many ways, we're justified on the belief that a new energy system would emerge and that California should wind down the current energy system that it has today. And so the policy is very consistent, I think, with the intent of the policymakers, and so we're just seeing that play out.
I'm going to get shouted at, but I think we've got about 40 seconds. Does it matter who's in the White House, given that we have a Democrat who wants to get rid of fossil fuels, but we also have 13 million barrels a day of production in America? Does it matter who's in the White House?
Well, because of some of the lead times I was mentioning earlier, what happens are decisions to make permitting more difficult, to cancel lease sales, to cancel pipelines. Those have impact down the road. What we see going on in the market today is a result of plans and permits that have been issued in years prior. And so there's a lag time in some of these things. And so some of the policies that you see come into play, the manifestation of them, I mentioned California, 20 years of policy making that's playing out today. Same thing applies at a federal level.
Mike, this was great. It's good to see you. It's great to catch up.
Good to
Mike
see you.
Worth there of Chevron. Manus Cranny, we'll throw it back to you. Good afternoon.
Lisa, thank you very much. Great conversation there. An interesting nuance between what goes through the Red Sea and the Strait of Hormuz. That is when the real crunch point will come from Saudi and Kuwait and those other nations traveling through there with their oil and their product. Countdown to the open finishes. We're in Davos at Davos House. Follow the blog. Follow everything on Bloomberg Terminal. Pick it up on Bloomberg.com. And of course, Bloomberg TV. I'll be with you tomorrow morning and we'll be back to Davos. This is Bloomberg.
is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
And stocks open lower as central bank officials push back against bets on aggressive interest rate cuts. Traders also waiting today for a speech from Federal Reserve Governor Christopher Waller. Going to get that around 11 o'clock or so, some of the prepared remarks. And that'll focus on the timing of Fed rate cuts, hopefully. Goldman Sachs, Morgan Stanley releasing earnings results. It wasn't a big turnout, but Donald Trump triumphs in Iowa. Good morning, I'm John Tucker, along with Lisa Mateo, in for Paul Sweeney, Matt Miller, and this is Bloomberg Markets. Right now, let's get a markets update. And with that, we turn to Nathan Hager. Hi, Nate.
And John, that update is brought to you by IBKR. Investment advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interests at ibkr.com/RIA. While we wade through bank earnings and wait for those comments from Fed Governor Christopher Waller in just about an hour's time, stocks, as you mentioned, are moving lower. Dennis Gardman, former publisher of the Gardman Letter, now chairman of the University of Akron Endowment Investment Committee, admits he missed the rally that ended last year, but he says the way things look to him, stocks want to trade sideways.
If you take a look again at the charts, since mid-December, we've gone effectively sideways in the S&P, effectively sideways in the Dow Jones, effectively sideways in the NASDAQ, and down a little bit in the Russell. But there has been very little correction thus far. I think there will be a 5 to 7% decline before we get back to oversold conditions. But right now, it appears the market wants to go sideways rather than lower.
And we do check the markets all day long here on Bloomberg. Right now, markets are pointed lower with the S&P down 20 points or 0.4%. 4763 is the S&P level. Dow Jones Industrial Average is down 191 points. That's a drop of 0.5% at 37,400. And the Nasdaq Composites lower by 58 points or 0.4%. 14,915 for the tech-heavy Nasdaq. 10 of the 11 main industry groups in the S&P are in the red. Energy and industrials are the biggest decliners. Communication services is just barely eking a gain. It's really little change to the upside. 10-year Treasury is down 18 seconds for a yield of 4%. The 2-year yield is at 4.18. NYMEX crude is down 0.5% now, down 37 cents at $72.31 a barrel. COMEX gold down 0.4%, down $7.80 at $2,043.70 per ounce. The euro weaker against the dollar, 1.0875. The pound, 1.2654. The yen is at 146.67. Goldman Sachs came in with solid results in equities trading, asset and wealth management, offsetting misses for fixed income and investment banking. Goldman Sachs shares are higher by about 1%, and Morgan Stanley is down 3 1/3% right now. Its net revenue beat, but equity and fixed income trading came up short. That's a Bloomberg Business Flash. Bloomberg Markets is on with John Tucker and Lisa Mateo.
All right, thanks, Nate. And let's jump in, take a look under the hood at some of the significant movers. Nora Melinda, Bloomberg News is here. Let's start off with Morgan Stanley. This is sort of the swan song for the head, James Gorman.
Right. So, I mean, of course, we had a lot of banks reporting last week and into this week. We have Morgan Stanley tumbling for its worst day since October as the market focuses on the bank's trading unit. Morgan Stanley's traders fell short again, dragging down profit at the firm, overshadowing the firm's wealth business unit beat. Net revenue from its wealth unit totaled more than $6.6 billion, higher than analyst expectations of $6.4 billion, due to higher interest rates that have helped boost net interest income. But the problem is that revenue from Morgan Stanley's fixed income trading business was little changed from a year earlier, which has disappointed multiple analysts who had expected an increase.
What's the outlook for the future? I mean, we heard from the CFO of the firm.
Right. I mean, the outlook has been really interesting, especially as people are hearing back from these firms. This comes after multiple banks reported with warnings about the future of their biggest source of revenue, which is net interest income. Wells Fargo actually had predicted a 9% slide in its net interest income this year. So, I mean, the future is really in focus as we look at these banks in the financial sector broadly.
Up next, a couple of firms, well, software firms, do I call them?
Yes.
Okay.
Can we count it? I guess we'll count it. Synopsys, that's a chip design company. It agreed to buy software developer Ansys for $34 billion in cash and stock. This is marking one of the largest deals announced worldwide in the past year. So pretty huge here.
And Boeing still under pressure.
It is still, I mean, you thought people forgot about January 5th and all that happened, but it is still at top of mind. Boeing is the second biggest laggard in the S&P 500 today by percentage, headed for its lowest intraday level since November. Everyone's pretty much still thinking about that near disaster of the 737 MAX Jet 9, and analysts are cutting their ratings on Boeing to equal weight, specifically an analyst at Wells Fargo. So seems like it's still a little bit of uncertainty as it relates to some of these airlines and the disaster that did happen with Boeing recently.
Those are some of the company-specific stories on a more macroeconomic level. We have some Fed speak today. That starts at 11 o'clock.
We do.
Chris Waller. And we got some over the weekend as well, which is one of the reasons we're seeing risk assets under pressure this morning.
Yes, I mean, everyone's really just listening to what these Fed speakers have to say. I mean, I think that provides us with some of the most color that we're looking for as we think about these prospective rate cuts moving forward. So Waller is definitely one to listen to today.
All right, that's 11 o'clock, and we'll probably get the prepared remarks right at 11 o'clock, so look out for that. Norma Linda, thanks a lot. Appreciate it. Let's bring in our next guest. Treasury yields climbing. There's growing speculation that the Fed may be reluctant about cutting interest rates as early as March. That seems to be in the driver's seat for markets today. Let's get more on the rates outlook. Ira Jersey, the chief U.S. interest rate strategist for Bloomberg Intelligence, joining us now, and he's not eating his lunch. So we're not interrupting.
It's not quite lunchtime here. I'm going to do that while I'm listening to Governor Waller. So.
Oh, okay. Well, so much. Well, give us the importance of Waller's speech today.
So Governor Waller moved the markets not so long ago when he mentioned that the idea of calibrating the federal funds rate with inflation. So with the idea that as inflation continues to moderate, that the Fed doesn't want the real Fed funds rate, so the difference between the Fed funds interest rate and inflation, to get wider and wider. And the way that he and some other members of the Fed view that is that would be tightening financial conditions even more than the Fed wants. So as you get a 20-25 basis point reduction in inflation, you can then expect a 25 basis point reduction in the Fed funds rate to keep that difference, that real Fed funds rate, constant. The Fed's never done that in a successful manner. They tried to in the mid '90s, and then you had LTCM and the Thai baht crisis and all of that. But but nonetheless, I think this would be like the dream scenario for the Federal Reserve. It would be, hey, let's cut interest rates a little bit as inflation comes down. If inflation hovers at 3%, then maybe the Fed funds rate should be 5% because it's still above our target, but it doesn't have to be at 5.5%, right? So that's kind of the idea that Waller's going to take. So some of the details of what he says today could be market moving in that if he sounds a little bit dovish, because he does say, hey, the Fed is probably going to cut because inflation's coming down, then maybe this sell-off in risk assets could turn around, and you can wind up seeing even a bit of a rally in the Treasury market after this morning's sell-off.
So we're listening out for Fed speak. There's also a ton of economic data out there. I'm looking at EcoGo, and I have mortgage applications, retail sales, import prices. There's also housing starts, jobless claims. We can't forget about the Beige Book too. What are you looking at in particular? What are you waiting for?
Well, the retail sales data tends to be pretty market moving. In fact, among all of the data that we look at and what moves the Treasury market, retail sales is the second or third most important to the knee-jerk reaction following the data release. And I think the fact that the consumer, we need to see the consumer continuing to edge along and be an impetus for economic growth in this country. I think retail sales are incredibly important. But we have to remember that most retail sales are actually in the goods sector, not necessarily the services sector, and services inflation is really what's been propping up the markets. And when there is more and more talk of people buying on layaway or using debt in order to purchase goods, so at some point that could wind up turning around, and that would be a significant drag on economic growth on a forward basis. So I think definitely retail sales will probably be the headline number for this week. Most of those other numbers, things like import prices and jobless claims, those are inputs to kind of bigger, more important, more detailed numbers. So we look a lot at the jobless claims numbers, and yes, they're very low, but that's also only half of the equation, right? Those are only how many people are being fired. It doesn't tell you how many people are being hired in any given week, right? And so if we have 200,000 people being fired and 200,000 being hired, then that's job growth of 0. So that's why it's important and an input, but it's not necessarily, doesn't tell you any kind of complete story. So that's why something like retail sales, which is a complete story, I think will help guide the markets this week, and that's really the key data point that we'll be watching.
We kind of knew manufacturing's in a recession, but that Empire manufacturing number, that's an eye-opener.
Yeah, it is a very noisy series, though. Like, keep in mind, like, we went from -38 to +9 in 1 month, and then we went from -5, or where were we last month? -14 to -43. So that's on a change basis, that's actually smaller than some of the other changes that we've seen in that series. So Empire tends not to have a great relationship with the headline national numbers. The ones that do better on a regional basis, at least the ones that we look at, and when we think about modeling overall U.S. manufacturing, is Chicago and Philadelphia and some of the other regional surveys. Empire tends to be a bit of an outlier in terms of its informational value for the overall economy. And part of that's just it's a relatively small region in terms of geography. It doesn't have the same kind of manufacturing base that it did, say, in the 1970s and before. So I do think that you can't take a lot from that particular number, although it is, pretty eye-opening. It is the second lowest number of the century except for April of 2020 during COVID. So yeah, it's something to keep an eye on, but I would watch the other regional surveys before, making any kind of decision as to what the health of the manufacturing sector is right now.
And we had some big bank earnings continuing this week. We got Goldman Sachs, Morgan Stanley. What are you looking at when those numbers come out? What stands out to you?
Well, so I'm not an equity person, but when I think about banks and the health of banks, I think about how much equity capital do they have, because from a liquidity perspective for the treasury market, you have the dealers that are attached to those banks that need equity capital in order to perform their market making operations. So when people buy or sell from say the JP Morgan Securities desk, JP Morgan Securities might take on some of that risk, and if they're having problems with that desk, if the sales and trading operations aren't making money, then they might pull back from doing those operations a little bit or take somewhat less risk, and in doing that, you wind up with more market volatility, and with trading volumes as high as they are and the amount of treasury debt outstanding, you can wind up seeing even wider swings and more wild swings than you've seen in treasuries. So when I look at that data, I look at how much interest rate risk are those banks taking, and how much capital are they willing to put toward their fixed income sales and trading operations, and that winds up driving some of the, not necessarily the directional view for markets, but certainly talking about things like volatility. Will realized volatility be much higher or lower than it has been in recent quarters?
Hey, let's talk curve inversion. I haven't touched on that in I don't know how long, at least with the part of the curve, the 2s and the 10s. That's improved, but it's still, negative 17 basis points. Why is it still inverted?
Yeah, it's still inverted because the short-term interest rates are still high, and the market is still expecting short-term interest rates to remain, 4.5%, 4.25% for the next year or so. So you over time you will see that curve uninvert, where you wind up seeing that negative 17 basis points become negative 10, and then 0, and then a positive sloped curve. So we think sometime in the second half of this year we'll see a positively sloped 2s, 10s curve. Part of it's a matter of time, part of it's math. If the Federal Reserve cuts as aggressively as the market is currently pricing, then it could happen, maybe even by June. I suspect that the market's gotten a little bit ahead of itself, and the Fed will cut a little bit more slowly than the market thinks. But nonetheless, you're going to see lower and lower 2-year yields. But remember, buying a 2-year yield today at where we are over 4%, right, 4.2%. If you buy that today, in a year, that's a 1-year note. So it's not like you're looking at a constant maturity note and taking advantage of that. So your new 2-year note that you could buy, say, in the summer will probably be 4%, maybe a little bit below 4%. But that's more of a function of what the Fed path is and just time going by, as opposed to a ton of people piling into 2s. That being said, 2-year notes here are pretty interesting, because if in order for you to lose money by the end of the year in buying a 2-year note, basically 2-year yields would have to double. So from a risk reward perspective, that part of the yield curve looks pretty interesting. You are limiting your upside, but at the same time, you're not taking a whole lot of downside risk, unless there's some absolutely insane thing that happens that forces the Fed to hike interest rates another 4 or 5%.
Now, Ira, the Fed goes into a quiet period next week. What's the message going into that week?
Yeah, I think it's more hold the course, that we are going to, we are watching inflation. We're still worried about inflation, but things are improving. So it's one of the reasons why I think over the weekend you had some Fed speakers and others even last week that were talking about the idea that the job's not done, but things are improving, right? So we've actually helped. So this, immaculate disinflation, or whatever you want to call it, that we've had over the the past year and a half. I think they'll keep on hounding on that type of theme. I think the important bit that might come out of some of that speak, and certainly what I'm looking for at the Fed meeting is, what's the propensity for them to be cutting at the March meeting? Because we're still pricing for some chance of a cut at that meeting. I think that's way too early. But so if we take that away, then the question is, what's the probability of a May cut? Will that stay the same, or will that shift meaningfully? And I suspect that if you take March off the table, then May is not going to be 100% priced, at least not initially. So that's the type of talk that I think we're going to have to listen to, and it's all going to be very nuanced, and they're not going to give us a lot of information, but that's going to be the important bits.
Oh no, Lisa, we didn't get any soccer questions in. Ira, thanks as always. Ira Jersey, the chief U.S. interest rate strategist for Bloomberg Intelligence. Ahead of Waller's speech, again, that's 11 Eastern, 11 Wall Street time. 2-year yields right now up 3 basis points. That is at 417. The benchmark 10 years up 6 basis points, right at 4% right now. As far as equities, S&P 500 13 points lower. This is Bloomberg. And that takes us to 10:18. You're listening and watching to Bloomberg Markets. I'm John Tucker along with Lisa Mateo. Time now for company news. And here's Steve Rappaport.
Good morning. Shares of Goldman Sachs are up after the Wall Street giant reported profit that topped estimates. Bloomberg's Charlie Pellet reports.
Steve, its equities trading unit posted a jump in revenue that was triple what analysts were expecting, capping what it's pitching as a year of transition. The firm's asset and wealth division had its highest quarterly revenue in 2 years, boosted by a gain tied to the sale of a financial management business, and that helped counter fixed income trading results and investment banking fees that fell short of expectations. Goldman is trying to put behind it a year in which deal-making remained depressed and losses on real estate investments and the consumer business dragged down profit. Steve?
Thanks, Charlie. Elon Musk is putting pressure on Tesla's board of directors to set himself up for a major payday. More from Bloomberg's Jeff Bellinger.
Steve, Musk is looking for a massive performance award to boost his stake in the electric car company. He sold about $40 billion worth of his Tesla stock in 2022 to raise the money he needed to buy Twitter. That left him with a Tesla stake of around 13%. Musk is still Tesla's biggest shareholder, but he told the board that unless he has close to 25% of the company, he might prefer to build artificial intelligence products and robots elsewhere. Steve?
Thanks, Jeff. Tesla shares are currently up more than 1%. And the NFL sets a live stream record with Comcast's playoff game between the Chiefs and the Dolphins. I'm Steve Rappaport. This
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager, and we check the markets all day long on Bloomberg. Stocks are falling, bond yields are rising off of bank earnings, and as we await more comments from the Fed, Governor Christopher Waller of the U.S. Central Bank is due to speak in just a little more than a half hour's time. Ahead of that, the S&P is down 9 points, or 0.2%. The Dow Jones Industrial Average is down 99 points, or about 0.25%. The Nasdaq Composite's down 14 points. That's a drop of 0.1%. 10 of the 11 main industry groups are in the red right now, led lowest by energy and industrials. We're watching NYMEX crude fall about 0.9%, trading at $72.04 a barrel as oil traders assess ongoing tensions in the Red Sea. 10-year Treasuries down 16/30 seconds for a yield just shy of 4%, 3.9992. And the 2-year yield is at 4.17%. COMEX gold is down 0.4%, or $8.10 at $2,043.50 per ounce. The euro trades at 1.0881 against the dollar. The pound is at 1.2658. The yen, 146.70. All those currencies weaker against a strengthening dollar. That's a Bloomberg Business Flash. Bloomberg Markets continues with John Tucker and Lisa Mateo.
All right, thanks a lot, Nate. Pairing some of the earlier losses, at least with the S&P 500. Rate cut in March by the Federal Reserve, virtual shoe-in, at least as far as the markets are concerned. And we're going to get a deeper dive and listen to some of the comments from one of the Fed officials, Chris Waller. That is expected around 11 Eastern, and we'll bring you those comments as soon as they cross the Bloomberg. Well, the bank earnings, they continue to roll in. Let's get an update. Allison Williams of Bloomberg Intelligence walks us through some of the results. We got Morgan Stanley, Allison. We also heard from Goldman Sachs. Give us the overview. One of the takeaways I got from last week was there's kind of like JP Morgan, Chase, and everybody else. What about today?
So today we get sort of a better look at, what the whole trading and investment banking fee pool looks like, right? So last Friday, we heard from all the traditional lenders, but these two are much more focused on the markets. I think one of the takeaways is that trading and fees relatively resilient. So we had misses in FICC. We had some surprises in equity.
Fixed income commodities trading.
Correct. Some surprises in equities. And in general, if you look at the whole picture, trading and fees coming in about flat compared with a year ago. And we think that's a pretty good result considering that trading was really strong in the year-ago quarter. And investment banking fees, something that we're watching, we are seeing stabilization. A little bit of disappointment, I think, on the M&A side. The announcements also signaling that those fees could be weak in the first half.
This is James Gorman's swan song, is it not?
Well, it's Ted Pick's show now.
He's the CFO at this point, right?
He's the new CEO, Ted Pick. So he took the reins and he gave a little bit more, sort of a tepid view, I guess, on the strategic goals, which we think is appropriate. I mean, Gorman came out with these very ambitious goals for Morgan Stanley. He came out with these goals in January of 2022. Keep in mind, 2021, what an amazing year that was. 22 was a rough year. 2023, we saw some improvement in some businesses, but I think the disappointment at Morgan Stanley really has been on the wealth flows. And what we're seeing is that those wealth flows rebounded a little bit in the fourth quarter after, kind of missing in third quarter, but still a little bit weak. And so basically affirming for the most part the targets, but taking away the upside. So less than 70% cost ratio is now 70%. And a 30% plus pre-tax margin is now 30%. But what's interesting to us is they still kept a very aggressive goal, the 10 trillion goal, which is now 10 trillion plus. So that was the one area they're a little bit more optimistic, and we think that's still a pretty aggressive goal for them, especially with the wealth flows that, they were very strong in the first half, but we've already seen some moderation. And then there's some pretty decent equity gains market gains overall factored into those targets over time.
Now, Allison, you touched on this a little bit. I want to see if you can dig a little bit deeper. Compared to what we heard from last week's bank earnings and then this week, where do you see the major difference and where it's headed?
So I think, again, it's a little bit more of a strategic difference in terms of getting more, I guess, light on the trading and fee side of things, and also the wealth management side of things. I think what's interesting from these two players today, the wealth and asset management business is really helping their success. As I said, maybe taking off a little bit of the upside to the long-term view at Morgan Stanley, but still really benefiting these two companies. And to the fact that we entered this quarter with higher asset values, that's good for the wealth business, because the wealth business in the U.S. tends to price based on that starting point. So the weakness that we've seen doesn't have as much of an impact. We're also seeing headcount trends at the banks that are pretty similar to what we expected to see, a little bit of moderation in the fourth quarter. That's typical with the seasonality.
Goldman's results, I want to say, maybe a little messy, but on equities trading, that was a big beat over Morgan Stanley. Why such a difference between the two?
It is. And, what's interesting is, years and years ago, Goldman Sachs was number one. Morgan Stanley took the lead under, helped by Ted Pick's leadership, and did a lot better in trading. But Goldman Sachs has really made a lot of progress in the last couple of years. It's interesting because the prime business, we think, is really helping the banks. However, as Morgan Stanley pointed out, there are, higher funding costs associated with those balances, liquidity costs, and that's what they really attributed the shortfall to. But, we look back at sort of the timing of the switch in leadership, which really sort of happened around Archegos. That the year that happened, Morgan Stanley had a big loss. Goldman Sachs did not. If you looked at the reported numbers, Goldman Sachs actually did better than Morgan Stanley that year, which is sort of a foreshadowing, because now they've sort of definitely taken the lead and expanded that lead, as you saw with the fourth quarter results, as you point out.
I wanted to ask David Solomon, is he still in firm control of Goldman? Where do we stand there?
He is, and though there's a lot of noise about sort of the missteps at Goldman, but what I think is important is, those missteps are in sort of the incremental businesses. So that was a strategy put in place under his predecessor in terms of trying to expand and go after retail. And I think this year, they said, that's it. We're just going to focus on our core businesses, and they're doing well, as we just said.
What happened to that Apple credit card? I mean, that was another misstep in retail, was it not?
Yeah, I mean, there's been a lot of noise around that. That was one of the relationships when they had sort of said that they were getting out of the consumer unit. They said that they would keep sort of the partnerships with Apple and, some of their other partners. But the one thing I would point to, over the many years I've covered credit card and, what the way these partnerships work is that, sometimes you don't know if it's the economics. One partner just, thinks wants a bigger share of the economics, or a competing, someone comes in and aggressively wants to bid for the business and just offers a better deal. Of course, all the players talk their book, and it's hard to tell from the outside who the winner is, but I would keep in mind that sometimes the economics may not have been so favorable.
Okay, what's the next quarter? I guess that would be the first quarter. What's that going to look like for the banks? What are we learning?
So for Goldman and Morgan Stanley, probably pretty good, and that's just due to seasonal trends. There tends to be a lot more activity in the first quarter. Definitely, we think that there's some momentum in debt issuance. That's going to help. M&A fees, as I said, we're not getting as much from the banks. When we turn to the net interest income side of things for some of the bigger traditional banks, we're going to continue to see that soften for some of the key players. As you said, JP Morgan is sort of stands alone a little bit in terms of their resilient. But I think from the loan perspective, we'll continue to see credit card, continue to see some weakness in some other loans, continue to watch on credit to see what's going to happen, as credit cards been normalizing, but does that start to worsen a little bit more and investors start to worry a little bit about that?
And Allison, before we go, do regional banks matter?
They do matter. I mean, they matter a lot. They're probably not as exciting to perhaps a generalist who was watching the headlines all of last year. But I would say that, commercial real estate, which is something that Wells Fargo is the biggest lender in, we definitely saw some weakness happening there. I would expect that we're going to see that play out across the regional banks. And then the net interest income story, as I said, for Wells and Bank of America, they're talking about a trough in second half. We'll be watching to see at the regional banks if we're going to get a similar guide.
Who's up next?
Who's up next? Well, the big six that I cover are done. So for me, the one up next is going to be Deutsche Bank, who reports next week. We're going to see, these fixed income trading results are not great for them. However, equity trading results are good for UBS, which we also cover. But we'll be getting, from on the back to the regional banking side, a ton of those covered by my colleague Herman Chan are going to be reporting in the next few days. So we're going to be looking to hear, what those core trends are.
Good to see you. Thanks for stopping by the studio. Appreciate it. It was great. Allison Williams, Bloomberg Intelligence, walking us through the results of some of the banks. Of course, Goldman Sachs, Morgan Stanley just reporting this morning. Right now, S&P 500, 6 points lower. That's down about 0.1%, shaping some of the earlier losses. 47.77 on the index. The NASDAQ Composite Index up 7 points. The Dow right now, 124 points lower. You are listening to Bloomberg Markets. I'm John Tucker along with Lisa Mateo, and that brings us to 10:33 on Wall Street. Let's get an update of news around the world. Let's head to Washington now. And my buddy, Amy Morris. Hi, Amy.
Hi, John. Thanks so much. Donald Trump, as you know, has tightened his grip on the Republican presidential nomination after Iowa voters delivered him a victory in yesterday's caucuses. Greg Valliere is chief U.S. policy strategist at AGF Investments, and he's not ready to declare Trump the winner just yet.
Let's see how New Hampshire turns out. It's possible Nikki Haley could have a strong second. Let's see how South Carolina turns out a couple of weeks later, where Haley could do well. But I'd out of caution, I will say maybe this goes until March 5th, but I don't think it's going any longer.
Now that Trump has cruised to victory in those caucuses, the former president's calling on his rivals to drop out.
And I really think this is time now for everybody, our country, to come together. We want to come together, whether it's Republican or Democrat or liberal or conservative. It would be so nice if we could come together and straighten out the world and straighten out the problems and straighten out all of the death and destruction that we're witnessing.
And Bloomberg Politics contributor Rick Davis explains how this could unfold from here.
If Trump does run the table and gets both Iowa and New Hampshire, a really unusual thing, then he's got 4 weeks to consolidate his hold on South Carolina. And we've seen early polling. And then after that, the really next big thing is Super Tuesday. So he could actually walk into Super Tuesday basically unchallenged at that point.
Now, Bloomberg Politics contributor Rick Davis also says a Trump presidential victory, when all is said and done, could result in some sweeping changes for U.S. policies that would include trade, overseas conflicts, taxes, and civil rights. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$10:40 on Wall Street. I'm Nathan Hager. Stocks are falling, though, pulling back from some of their earlier losses. Bond yields continue to rise on speculation that aggressive rate cut bets from the Federal Reserve may be overdone. Priya Misra, portfolio manager at JP Morgan Investment Management, says the U.S. may be in a soft landing now. She says that would be positive for all risk assets.
If inflation continues to decline close to 2% and the unemployment rate doesn't really rise a whole lot, those real rates can decline. The Fed stops QT, and that's actually positive across risk assets. We see a continuation of the fourth quarter move.
Well, let's check risk assets right now. The S&P 500 is now little change to the downside, down 3 points. The Dow Jones Industrial Average is down 94 points, or about 1/4%. The NASDAQ Composite is swinging between gains and losses, now in the green, up 14 points. That's a gain of about 0.1%. 10-year Treasuries down 16/32. The yield very close to 4%. 2 years at 4.16. NYMEX crude is down 1.1%, trading at $71.90 per barrel. COMEX gold is down about 0.4% at $2,044.40 per ounce. The euro is weaker against the dollar, 1.0886. The yen at 146.68. We're watching shares of Google parent Alphabet on a Business Insider headline that Google plans to cut hundreds of employees in its ad sales team. Class A shares of Alphabet are higher by 0.4%. The biggest decliner on the S&P right now is Boeing. That's after analysts and some of the plane makers' key customers raised concerns that heightened scrutiny of the grounded 737 MAX 9 could mean slower aircraft deliveries. Boeing shares are lower by more than 6.5%. That's a Bloomberg Business Flash. Bloomberg Markets continues with John Tucker and Lisa Mateo.
All right. Thanks a lot, Nate. We appreciate it. On the inflation front, the data we recently got showed a hotter than expected CPI. Of course, that was followed by the PPI, showing expected wholesale prices were coming in a little hotter than expected, or I should say a little cooler than expected. So what's the Fed official to do? Our next guest, Marianne Bartel, CEO at Sanctuary Wealth. Marianne, thanks for being with us. Appreciate it. Always good to talk to you. The trajectory for inflation seems to be lower at this point, but the last mile to a 2% target kind of full of fits and starts. What is your impression?
Well, we've been saying that inflation has peaked, and you're right. The trend can be fits and starts, but you want to look at the longer term trend, and we do believe it's down. And if you look at on the CPI, if you look at the 3 and 6 month annualized number, you're already at 2%. So the momentum is definitely to the downside. So despite that slight uptick in CPI, we still think the trend is down. And as you pointed out with PPI, which is really not getting a lot of attention, on a year-to-year basis, it's actually negative. So we've already seen the producer prices come down dramatically. And we think over time, you're going to see CPI do the same thing.
Now, here I'm looking at a Bloomberg article that was on this morning about a Bank of America study. It says optimism over Fed interest rate cuts has pushed investors' optimism on stocks. Are you seeing the same?
Yes. In fact, if you look at last year, there was a lot of expectations throughout the year that the Fed would cut rates, and they didn't. So you had this volatility enter the market based on expectations. We think this year it could be exactly the same. We do think that there's a lot of rate cut expectations built into the market. You're starting to maybe see some volatility of a backing off of that a little bit. But I think what we have to keep in mind is there was a dramatic rally from the October lows to the end of December. And when you have such a large move, and that was both in stocks and bonds, you saw stocks rally and yields fall dramatically, particularly on the 10-year. You need to digest those. And now that we've entered earnings season, we're going to have to digest those as well. So a little bit of digestion for the fixed income market and the equity market would be considered very normal. We've called this year the year of the bucking bull for both bonds and stocks. meaning we're going to see a lot of bucking in a bullish environment for both asset classes. But we think if you stay with those asset classes, you'll be very happy by the end of the year.
Marianne, we're going to have to leave it there. We're going to head to Davos right now. Marianne Bartel, CEO at Sanctuary Wealth. Thanks very much for being with us. Bloomberg Markets is at the World Economic Forum in Davos, Switzerland. It's going on this week. Among the participants, OpenAI CEO Sam Altman and OpenAI's Vice President of Global Affairs. They are sitting down right now for a conversation with Bloomberg's Brad Stone. Let's head to Switzerland, listen into that conversation.
This is not, no one wants to sit up here and hear me rant about politics, so I'm going to stop after this, I promise. But I think there has been a real failure to sort of learn lessons about what's kind of working for the citizens of America and what's not.
Anna, I want to ask you the same question. Taking your political background into account, what do you feel like for Silicon Valley, for AI is at stake in the U.S. election?
This is the Vice President of Global Affairs, Anna
Really
Bagancha.
remarkable is that the conversation around AI has remained very bipartisan. And so, I think that the one concern I have is that somehow...
Both parties hate it.
Yeah. No, but, this is an area where, Republicans tend to, of course, have an approach where they are not as in favor of regulation. But on this, I think there's agreement on both parties that they believe that something is needed on this technology. Senator Schumer has this bipartisan effort that he's running with his Republican counterparts. Again, when we speak to people in D.C. on both sides of the aisle, for now, it seems like they're on the same page.
And do you feel like all the existing campaigns are equally articulate about the issues relating to AI?
I don't know that AI has really been a campaign issue to date. So it will be interesting to see how that evolves.
If we're right about what's going to happen here, this is bigger than just a technological revolution in some sense. I mean, sort of like all technological revolutions are societal revolutions, but this one feels like it can be much more of that than usual. And so it is going to become a social issue, a political issue. It already has in some ways, but I think it is strange to both of us that it's not more of that already, but with what we expect to happen this year, not with the election, but just with the increase in the capabilities of the products. And as people really catch up with what's going to happen, what is happening, what's already happened, there's a lot of inertia always in society.
Well, there are political figures in the U.S. and around the world, like Donald Trump, who have successfully tapped into a feeling of dislocation, anger of the working class, the feeling of exacerbating inequality or technology leaving people behind. Is there the danger that AI furthers those trends?
Yes, for sure. I think that's something to think about. But one of the things that surprised us very pleasantly on the upside, because when you start building a technology, you start doing research, you kind of say, well, we'll follow where the science leads us, and then when you put a product, you'll say this is going to co-evolve with society, and we'll follow where users lead us. But it's not. You get to steer it, but only somewhat. There's some which is just this is what the technology can do, this is how people want to use it, and this is what it's capable of. And this has been much more of a tool than I think we expected. It is not yet, and again, in the future it'll get better, but it's not yet replacing jobs in the way, or to the degree that people thought it was going to. It is this incredible tool for productivity. And you can see people magnifying what they can do by a factor of 2 or 5, or in some way that doesn't even make sense to talk about a number because they just couldn't do the things at all before. And that is, I think, quite exciting. This new vision of the future that we didn't really see when we started. We kind of didn't know how it was going to go, and very thankful the technology did go in this direction. But where this is a tool that magnifies what humans do, lets people do their jobs better, lets the AI do parts of jobs, and of course jobs will change, and of course some jobs will totally go away. But the human drives are so strong, and the sort of way that society works is so strong, that I think, and I can't believe I'm saying this because it would have sounded like an ungrammatical sentence to me at some point, but I think AGI will get developed in the reasonably close-ish future, and it'll change the world much less than we all think. It'll change jobs much less than we all think. And again, that sounds, I may be wrong again now, but that wouldn't have even compiled for me as a sentence at some point, given my conception then of how AGI was going to go.
As you've watched the technology develop, have you both changed your views on how significant the job dislocation and disruption will be as AGI comes into focus?
So this is actually an area that we have a policy research team that studies this, and they've seen pretty significant impact in terms of changing the way people do jobs rather than job dislocation. And I think that's actually going to accelerate in that it's going to change more people's jobs. But as Sam said, so far, it hasn't been the significant replacement of jobs.
You know, you hear a coder say, okay, I'm like 2 times more productive, 3 times more productive, whatever, than they used to be. And I like can never code again without this tool. You mostly hear that from the younger ones, but it turns out, and I think this will be true for a lot of industries, the world just needs a lot more code than we have people to write right now. And so it's not like we run out of demand, it's that people can just do more. Expectations go up, but ability goes up too. Demand goes up.
I want to ask you about another news report today that suggested that OpenAI was relaxing its restrictions around the use of AI in military projects and developing weapons. Can you say more about that? And what work are you doing with the U.S. Department of Defense and other military agencies?
So a lot of these policies were written before we even knew what these people would use our tools for. So this was not actually just the adjustment of the military use case policies, but across the board to make it more clear so that people understand what is possible and what is not possible. But specifically on this area, we actually still prohibit the development of weapons, the destruction of property, harm to individuals. But for example, we've been doing work with the Department of Defense on cybersecurity tools for open source software that secures critical infrastructure. We've been exploring whether it can assist with veteran suicide. And because we previously had what essentially was a blanket prohibition on military, many people felt like that would have prohibited any of these use cases, which we think are very much aligned with what we want to see in the world.
Has the U.S. government asked you to restrict the level of cooperation with militaries in other countries?
They haven't asked us, but we certainly are not, right for now, actually, our discussions are focused on United States national security agencies. And, I think we have always believed that democracies need to be in the lead on this technology.
Sam, changing topics, give us an update on the GPT store. And are you seeing, probably explain it briefly, and are you seeing the same kind of explosion of creativity we saw in the early days of the mobile app stores?
Yeah, the same level of creativity and the same level of crap. But that happens in the early days as people feel out the technology. There's some incredible stuff in there too.
Give us an example.
The GPTs, should I say what GPTs are first?
Yeah, sure.
So GPTs are a way to do a very lightweight customization of ChatGPT. And if you want it to behave in a particular way, to use particular data, to be able to call out to an external service, you can make this thing, and you can do all sorts of great stuff with it. And then we just recently launched a store where you can see what other people have built and you can share it. And personally, one that I have loved is All Trails. I have this every other weekend, I would like to go for a long hike. And there's always the version of Netflix that other people have where it's takes an hour to figure out what to watch. It takes me 2 hours to figure out what hike to do. And the All Trails thing to say, I want this, I want that. I've already done this one, and here's a great hike. It sounds silly, but I love that one.
Have you added any GPTs of your own?
Have I made any?
Yeah.
I have not put any in the store. Maybe I will.
Great. Can you give us an update on the volume or the pace at which you're seeing new GPTs?
The number I know is that there have been 3 million created before we launched the store. I have been in the middle of this trip around the world that has been quite hectic, and I have not been doing my normal daily metrics tracking. So I don't know how it's gone since launch.